Investor Advisory Committee meeting. We are going to begin this afternoon's session with our first afternoon panel regarding digital engagement practices. This panel is going to be moderated by Paul Roy. Paul, over to you.
All right. Thank you, Christopher. I'd like to welcome all watching this afternoon to our discussion on the use of digital engagement practices by broker dealers and investment advisors. The Investor Advisory Committee has taken note of the fact that, as directed by Chairman Gensler, they've issued a request for comment gathering information about the increased use of digital engagement practices by online trading platforms and mobile apps that appeal to an increasing number of retail investors. These include behavioral prompts, differential and targeted marketing, game-like features commonly referred to as gamification, and other design elements or features to engage with retail investors on digital platforms. Now, while these platforms and apps can make investing in securities easier and more accessible, they can also include features designed to encourage investors to trade more often and manipulate their behavior. Predictive analytics and other digital engagement practices can be designed with optimization features to increase revenues, data collection, or increase time spent on a platform. This also may lead to conflicts between the platforms and investors, as Chairman Gensler noted earlier this morning. Indeed, Chairman Gensler indicated that on the spring Reg Flex agenda, the SEC has indicated that the agency will consider recommending that it propose rules related to prohibiting investment advisor and broker-dealer conflicts in the use of predictive analytics, artificial intelligence, machine learning, and similar technologies in connection with certain investor interactions. Moreover, the SEC's examination division, when it issued its examination priorities for 2023, indicated that broker-dealer and registered investment advisor examinations will focus on digital engagement practices and related tools and methods to assess whether recommendations are being made or advice provided is in the best interest of investors. In the last several years, there have been a significant increase in new entrants into the securities markets. Barriers to entry for retail investors have fallen as firms often offer low or zero cost commission trading, no minimum balance accounts, and the opportunity to trade fractional shares. According to a recent FINRA study, 38% of new accounts were opened by investors under the age of 45 who did not own other investment accounts before the year 2020. These investors typically have lower incomes and they come from racially and ethnically diverse backgrounds. As a result of targeted marketing, including by well-known athletes and celebrities, young Black Americans are even more likely to first experience investing through high-risk cryptocurrency investments. According to a recent Ariel Charles Schwab survey, nearly a quarter or 23% of Black investors under 40 indicated that their first investment was in cryptocurrency. Unfortunately, a significant amount of the losses incurred in cryptocurrencies have been borne by these investors who are seeking rapid gains without the knowledge or information to assess the risks associated with such investments. These folks are part of the class of investors that have been impacted the most by digital engagement practices. Now, the SEC received hundreds of comments on its request for information on digital engagement practices. And most of these comments came from retail investors. Comments from retail investors range from approval of digital engagement practices, allowing users to access useful information and facilitate their investing. But on the other spectrum, retail investors refer to it as gamification, designed to lure younger, novice investors who don't understand the risk of their investments. Industry commenters, including brokerage firms that employ digital engagement practices and trade associations that represent industry professionals, generally took the position that no additional rulemaking was necessary and that the existing regulatory regime adequately addresses firms' use of digital engagement practices. Existing regulations they referenced were FINRA communication rules and guidance, regulation best interest, and an investment advisor's fiduciary duty obligations. These commenters further asserted that additional regulation may well have the effect of limiting information and access to investment opportunities and educational tools by underrepresented, less financially educated, and less affluent retail investors. Now, investor-oriented groups generally viewed existing regulatory requirements as adequately addressing most issues arising from digital engagement practices, but that there may be a need to fill in some gaps to address particular issues and conflicts. Suggestions included more guidance as to when digital-based communications constitute recommendations under regulation best interest, taking steps to mitigate or eliminate conflicts of interest like payment for order flow, and impose measures and requirements to protect self-directed investors. In our panel discussion this afternoon, we will discuss the use of various digital engagement practices and targeted marketing and the impact on investors. We will discuss the benefits and risks of digital engagement practices, the use of analytical tools and technologies, and whether balanced regulatory action may be needed to enhance investor protection while preserving the ability of investors to benefit from the use of these technologies by broker-dealers and investment advisors. I'm pleased that we have a distinguished group of panelists to discuss this important issue. Now, you can access their impressive bios on the SEC website for this session. So first we have Melanie Chardock. She's Acting Associate Director and Practitioner in Residence at the University of Miami School of Law Investor Rights Clinic. And we were scheduled to have Algernon Austin, who's Director for Race and Economic Justice, the Center for Economic and Policy Research. Algernon had an emergency this morning and won't be able to join us, but he did provide a statement, and I will try to summarize his thoughts later in our session. Then we have Siva Ramakandran, Director of Capital Markets Policy for the CFA Institute. And Siva joins us from Mumbai, where it's 10:30 p.m. tonight. So thank you, Siva, for being with us. And then we have Jasmine Sethi, Associate Director of Policy Research at Morningstar and CEO of Sethi Clarity Advisors. And then finally, James Tierney, who's Assistant Professor of Law, currently and beginning his professorship at the Chicago Kent College of Law. Previously, he was at the University of Nebraska College of Law. We'll take questions after each of our panelists has presented. So first, we want to begin with Melanie. Melanie, your investor rights clinic in Miami has represented clients that have engaged with various digital platforms. We're hoping you can discuss the various types of digital engagement practices and your clients' experience with these platforms that employ the practices and issues that have arisen. Melanie, turn it over to you. Are you there, Melanie?
I am now.
Okay, thank you.
Thank you, Paul, and I'd like to thank the IAC for inviting me to speak on this very important topic. The world of investing has significantly changed over the past few years as access to the capital markets and other investment opportunities is now literally in the palm of our hands. Recent technology has made investing almost frictionless. With just a swipe on a smartphone, investors can execute securities transactions without a broker's help. This evolution has both positive and negative outcomes, as seen by the clinic. On the positive side, pretty much anyone over 18 with a smartphone can invest with relative ease. On the negative side, this instant access without proper regulation can lead to risk-taking and devastating losses to those who can least afford this. A study conducted by FINRA in 2020 during the pandemic focused on the substantial increase in investment accounts and revealed that 3.6% of the U.S. adult population opened new taxable accounts for the first time. When the study was repeated in 2022, FINRA found that this trend continued, with 4.2% of U.S. Investors opening new taxable brokerage accounts. This shows that the influx of new investors continues to increase. Individual retail investors can now access markets and trade stocks on their mobile devices on a nearly 24/7 basis. More people are engaging with markets almost exclusively digitally, too. The majority of investors now access their accounts through mobile apps, and these apps are designed to induce new investors to impulse buy. As Chairman Gensler stated in a 2021 SEC press release addressing digital engagement platforms, DEPs, in many cases, these features may encourage investors to trade more often, invest in different products, or change their investment strategy. And according to Better Markets, this is gamification. Gamification is something that entails the design of addictive, endorphin-engendering game-like features for the purpose of generating more trading, more often, and more thoughtlessly. There are a number of ways that digital engagement is encouraged by these trading apps. These include, in no particular order, 1, free stock. If you sign up for certain trading apps or refer a friend, you can get free stock. Some apps even let you pick a fractional share in popular companies that investors might like. This can be worth up to $1,500 annually on some apps. This promise of free stock gets investors in the door, and it also keeps them engaged as they receive push notifications once they own a stock. 2, push notifications. A push notification is an alert, typically a pop-up or other message on your phone's home screen, generated by an app when the app is not open. This push notifies the user of a new message, update, or social media post. Some apps use these notifications, which magically appear on a smartphone, to send urgent-seeming messages regarding an investment. For example, a small movement in a stock in an investor's account can trigger a push notification such as, Apple stock has increased 1%, which has a consequence of the investor immediately engaging with the app to see what the price might be. Push notifications are used as a psychological prod to move a targeted user in a desired direction. Apps use push notifications to capture their users' attention and draw them towards executing trades. 3, watch lists. These lists of popular stocks or top stocks are often displayed in bright colors or with digital charts showing them moving up and have the effect of increasing demand by attention-induced trading. 4, eye candy. This engagement feature is in the app design itself and attracts attention through an aesthetically pleasing design. Bright neon colors, banners, and other eye-catching graphics can have the result of more digital engagement. 5, rewards or awards. App users are often given rewards or awards of cash that can only be used for trading on the app itself. Thus, these special awards offer the customer more capital to invest in stocks or crypto, encouraging more trading. 6, engagement games. Some apps have practice game trading for their users. Through this engagement, investors can practice trading options and securities. Though touted as a powerful tool to help investors test their strategies, build trading confidence, and get familiar with trading apps, in reality, this can build false confidence in a novice investor. 7, special enticements. Enticements such as buying power notifications, offering the investor more buying power through the use of margin, are an enticement for the investor to leverage their account by borrowing against their securities. All of these DEPs are by design created to increase user engagement in trading. Since commission-free trading platforms primarily earn their profits from payments for order flow and thus make money for each trade they execute, they require frequent user engagement to make more money. Because the average account size on popular trading apps is relatively small, the firms promote strategies that both encourage frequent trading as well as leverage the buying power of its users. DEPs lure customers into interacting more with the apps and trading more often. Additionally, margin lending and cash incentives, which increase an investor's buying power, provide more client funds for investing on the platform. And encouraging options trading, where less money is used per options contract versus buying a share of a security, promotes more frequent trading as well. Thus, the platforms are all incentivized to promote these trading strategies to their customers. As experienced by several clients of the clinic, trading apps target unsophisticated investors with marketing campaigns designed to make trading on margin or trading options seem easy and low risk. Unsophisticated investors with limited financial means and investment experience often rely on the information they receive from the trading apps. In many instances, these investors are using complex and risky strategies for the first time when they open a digital platform account, suggesting that the same investors would not have engaged in this activity or trading strategy absent the facilitation and education by the digital platform. Most of the victims we have seen are young adults under 30 who've never traded options before. Many of these investors not only lost their principal trading options, but also owed money to the firm for uncovered losses. Another disturbing trend were margin debit cases, where investors lost principal and additionally owed margin debit balances. We've seen this type of situation impact both young, novice investors as well as seniors who have never used margin before. What do all these scenarios have in common? In all of them, we have unsophisticated investors engaging in sophisticated investment strategies that in the past only licensed brokers and registered options principals could execute for them. Generally, though, we are unable to assist such investors who come to the clinic with potential claims because the firms take the position that since they do not technically make any recommendations, they are not subject to FINRA suitability rules or Reg BI. However, the analysis is more complex than this hardline situation and position. The clinic recommends that the Commission expand its interpretation of what constitutes a recommendation for purposes of trading platforms' use of DEPs. DEPs are designed to promote user engagement and encourage trading. But for the enticement dangled in neon colors or pushed as a notification on a smartphone, it's quite likely that the customer would not have engaged in a trade or trading strategy. Regulators need to expand their interpretation of existing rules to ensure that their definition of recommendation encompasses the very types of intentional stimuli that trading apps use to induce customers to execute frequent trades or use trading strategies. As stated in the adopting release of Reg BI, factors considered in determining whether a recommendation has taken place include whether the communication could reasonably be viewed as a call to action and reasonably would influence an investor to trade a particular security or group of securities. This is precisely what DEPs are, a call to action to engage in specifically targeted investment activity. It is appropriate that communications which are intended to psychologically induce customers to act on them should be recognized as recommendations requiring the trading apps to adhere to the mandates of Reg BI. Although DEPs may influence trading, firms operating these platforms stress in their customer agreements with their investors that the firm does not make investment recommendations. Some trading apps affirmatively state to their investors that the firms don't provide any investment recommendations other than when the firm affirmatively takes on this responsibility. We recommend that the Commission consider each DEP and whether they can or should come within the ambit of the SEC's Reg BI. At a minimum, the Commission should set forth guidelines that advise firms, 1, the types of DEPs that would be considered recommendations, and 2, pronounce that such boilerplate language in their customer agreements or Form CRS filings will not be determinative on the issue of whether a firm made a recommendation. Thank you for giving me the opportunity to express the clinic's views in this forum.
Thank you, Melanie. Appreciate that summary of DEPs, and we'll come back to the issue of the definition of recommendation after we go through the other presenters, but thank you for that. Now let's go to Jasmine. Jasmine, Morningstar offers a range of products for individual investors and professional financial advisors and institutional clients. And so Morningstar has a broad perspective on the use of digital engagement practices. And Morningstar also conducted a survey of a representative sample of investors regarding their use of trading apps and exposure to digital engagement practices. Can you discuss your views and findings of Morningstar?
Thank you, Paul. Happy to be here today. Good afternoon, everyone. So as Paul mentioned, we have submitted, my consulting firm partnered with Morningstar, and I also serve as the Associate Policy Director at Morningstar, a comment letter in response to the request for information on digital engagement practices, or DEPs. And that comment letter is in the materials for today's meeting. It is associated with the agenda. And so I'm going to talk about the survey that Paul mentioned, but I won't get through all the technical details behind the survey results. So if anyone's interested, they are well documented, particularly in the appendix to that comment letter. So Morningstar is very interested in investor protection and in looking at DEPs from what they can offer, both in ways that serve investors and in ways that may not. And DEPs are nuanced. It is not a simple question of good or bad. Some DEPs are good. Some DEPs are encouraging behaviors that we think are risky, as my co-panelist mentioned. And it also depends on the kind of investor. Of course, investors are not a uniform group. Morningstar conducted a survey of about 1,500 participants, and we looked at investors in different groups. So we had 4 different categories of retail investors. So I guess one would technically be non-investors, people who don't invest at all. Another category were passive investors, generally people who go through an advisor or a 401k platform, but do not engage with an app. Then we have what we call engaged investors, those who engage with an investment app, so do trades for investments, but not a trading platform. And then we had traders, those who actually are on trading apps and often trade on a regular basis. So in looking at these groups, we learned a lot of interesting things. First of all, we find that DEPs increase interest and knowledge for everyone. All groups of investors across the board, all these 4 groups, are more knowledgeable and more interested in learning, more engaged in investing than in the past, than in their pre-digital days. There are some caveats, of course. Some of it's looking, people who are older, obviously, people gain more wealth and experience with age. But in general, that seemed to be a consistent finding. So that goes to the point of DEPs can be good. It is great to have an engaged and informed investing public. So let's get into where DEPs can be good and bad. We want to distinguish between savings behavior and trading behavior. And it's really important to keep in mind that when we talk about digital practices and automation, this is a very broad area. And we have particular concern, Morningstar, and I think many of us here on this panel, about not discouraging retirement savings. There have been tremendous innovations in automating retirement savings, digital nudges, setting defaults, enrolling individuals into default funds, often target date funds or other alternatives that qualify under the Department of Labor's regulations. And subject to, plan fiduciaries are subject to a whole regulatory regime that's quite robust under ERISA. And so to qualify for those kinds of alternatives where people are put into defaults, people are automated in their initial saving, in their incremental increases, that is a well-regulated regime. And we do urge the Commission to not do anything that could interfere with that regime and could unintendedly discourage savings. In a similar vein, we think that automated advice in the form of robo-advisors has had tremendous benefits for retail investors. In general, Morningstar has found that robo-advisors are very low cost. Many of them are often operating at a loss for a long time. And we think that a lot of investors have really benefited from the accessibility of that investing, from the low cost nature of it, and the convenience of doing it on an app and having it automated to take money from your bank account or sometimes even from your spending, but to slowly build up those savings. It can be, based on linking a bank account, based on linking a credit card, any number of ways. But different things do work for different people, and we do think that encouraging that savings in that automated way, given many of the psychological biases that we know that get in the way of savings, has tremendous benefits. So the inertia to set things up, is countered by those default nudges that get people saving and get them to continue that saving. And we think those have been great innovations that have helped a lot of retail investors. So I would say in terms of distinguishing behaviors, we want to definitely distinguish between things like saving and what we might call over trading, or perhaps risky trading. At the same time, there is a group that we said, traders, calling themselves traders, who choose to trade and may have certain preferences that do not line up with the majority of investors. However, they may want to exercise those preferences through certain trading apps. Now, what we need to think about is defaults. And I think, as we talked about in the retirement context, there are some very useful defaults. But in certain trading apps, the defaults may not always be in the interests of the investor. Sometimes default settings are, as Chair Gensler mentioned this morning, more in the interest of the broker, or perhaps some kind of a joint optimization between preferences of certain investors and preferences of the broker. And there lies in a conflict of interest. So we need to think carefully about those sorts of defaults. And what we would encourage are both useful defaults and useful disclosures. So what we point out in our comment letter are examples of defaults, of course, that encourage savings, as well as default disclosures that provide people with useful information at the right time. A good example of such disclosures are just-in-time disclosures. Disclosures often provided right before people make a trade. For instance, if people make a trade on margin, they may not realize the full consequences of that trade in terms of how that might affect their account balance when that trade settles, or depending on how things go with the future price of what they are purchasing or selling. So to have a just-in-time disclosure explaining the potential consequences could be very useful and would allow the investor to make a much more informed decision at the right time of making that trade. Just-in-time disclosures have also been used to inform investors about the tax consequences of their trades, which can also be very useful and is a pretty complicated area. So let's look more at trading and some of the notifications and depths that customers are getting. And I'm distinguishing trading from, like I said, the savings apps. I'm focused more on the brokerage trading apps here. We do not really see these kinds of problematic behaviors in the sort of robo-advisor or investment advisor automated context. Looking at the trading apps, there is a number of things that people see in these apps. And as my co-panelist Melanie mentioned, some of them, lots of interesting, color coding, prizes, and so forth. We looked specifically in our survey, and we found that the majority of investors across groups see badges, leaderboards, contests. These are all depths identified by the commission as well. And push notifications. Lots of push notifications. I know that was mentioned earlier. Push notifications run the gamut, of course. They can be informational, they can be encouraging certain behaviors. They're not necessarily problematic in our view if they're just informational, but they can, in some cases, go further than that. Now, the other interesting thing we looked at is what do customers actually want? So investors do have preferences, and yes, they can go in and change their settings and so forth, but their preferences could also be accounted for in setting up the defaults to begin with. A lot of customers don't actually like a lot of these things. Actually, across the board, they generally don't care for these badges and leaderboards and contests. The only ones who seem to like the push notifications are the traders, which makes sense because they are actively engaged more often and are potentially using those push notifications to act on them. So it does raise the question as to whether they should be a default. But we wouldn't necessarily go so far to say that the information is a recommendation. We do not think that that alone, just to provide the information, constitutes a recommendation. However, a default placement into a risky account, such as a margin account, to have an investor defaulted into a margin account, we would argue is potentially a recommendation under regulation best interest for that kind of trading. And we think that doesn't necessarily require new regulation. That just may be something that can be detected during the enforcement and examination under regulation best interest. We do think that clear guidance from the Commission to articulate that defaults should be considered in terms of whether they are in the interest of investors and whether or not they present a conflict is important in executing your duty when you are acting in the best interest of your clients. To that end, we also note that customers do not appreciate behaviors that are a conflict. Most customers do not want their data sold, and they do not want their commissions. They do not want their brokers making commissions on trades without them knowing about it. Pretty common sense, I think. So we think that those kinds of conflicts should be disclosed. Simply, easy to read, very easy to find in the apps. So we think good conflicts of interest disclosures, and that's consistent with regulation best interest as it is, should be disclosed in these apps, as well as clear cost information. Again, it should be easy to find, easy to read, comparable, very transparent, easy to compare across apps. And so our recommendations, to summarize for regulators, is to be clear on what disclosures are expected, in these apps, particularly relating to conflicts and costs, and to make some clear guidance and clear enforcement around risky defaults in trading apps, or I should say defaults that could encourage risky behavior in trading apps, and to look at those to see if perhaps they do look like they constitute a recommendation, and those should be discouraged, so that investors are treated in ways with their defaults that are actually in line with their best interest. Thank you very much for allowing me to contribute to our discussion today, and I look forward to questions.
Thank you, Jasmine. Your comments really highlight the difficulty in line drawing here with regard to digital engagement practices. And as you point out, there's some nuances, and maybe there's some areas where there's some clear problems that should be addressed, and others that are beneficial for investors. And we'll come back to that in the Q&A, but thank you for your comments. Now let's go to Siva. Siva, you recently authored a report entitled Fun and Games, Investment Gamification and Implications for Capital Markets. And the CFA Institute also conducted an investor study focused on gamification. Can you discuss your research findings and recommendations to regulators and the industry to maximize the benefits and minimize the risks from the increasing use of digital engagement practices?
Thanks, Paul. Thanks. I thank the IAC for the opportunities to present our views on gamification. I also thank the previous panelists for their excellent comments, some of which resonates in our report as well. I have prepared remarks, but I also have a few slides. I don't know if we can pull it up, and that then we can go through some of it. Thank you. So. Like Paul said, I'll highlight our research as well as findings from our report titled Fun and Games. Can we move to the next slide, please? Thank you. I think our previous panelists, Melanie as well as Jasmine, had talked about the positive effects of gamification. When used well, gamification techniques can be a powerful tool for engagement, literacy, and driving positive outcomes. In the financial services context, gamification can attract new, younger audiences at the stage of their lives when they should take risks. I think Melanie mentioned about the number of people age 18 and above, opening investment accounts. That's the right age for taking investment risks. And and I think there was also comment about savers versus investors. A lot of investment apps outside brokerages, like retirement apps, personal saving and budgeting apps, they use gamification to improve savers' outcomes as well. And clearly, engagement results in improved trading activity, which reduces transaction costs and improves liquidity. Although one would argue that where is the line when it comes to excessive trading? But there are concerns as well. Can we move to the next slide, please? So broadly, when we think about gamification features, the way we think about it is three categories. Some features attract attention. People talked about push notification in quite a bit, quite at length. UX design, aesthetics, and presentation of information. All of these features attract attention. The second kind of features is they activate social aspects of trading. Think about leaderboards and copy trading. And the last one, which is mostly in the realm of behavioral nudges, not strictly gamification, are features that increase convenience. So think zero commission, ease of account opening, one-click trading. I think Jasmine talked about margin defaults instead of cost defaults. So I think some of these features increase convenience. We particularly focus on UX design, borrowed from Gambling World. In her book, Addiction by Design, the author describes how designers strive to use color, light, animation, sound, and space with an intent to increase time on machine when it comes to slot machines, and put the gamblers in a zone where it's not the wins or losses that matter, but what matters is the next spin. Right. So when you borrow those kind of features and put them in brokerage apps, I think you are going to end up with excessive trading. Even UX design and dark patterns are problematic. An ESMA study documented that the use of bright colors for buying, but gray or nearly invisible buttons for canceling orders is an example of what you call dark patterns. So these features are frequently found in brokerage apps which employ gamification. Can you move to the next slide, please? One of our contributions in this paper is that we take every gamification feature and we try to figure out what is the behavioral explanation or potential implications. I won't go through all the items on the list, but take the last item on the list, posting trades in social media. Posting trades on social media is what you would call a commitment device. Now, commitment devices are a way to lock individuals into following a plan of action they might not want to do, but they know is good for them. These devices are used in many settings, like piggy banks, New Year resolutions, and health apps that allow users to share their statistics with their social network. They are, in theory, commitment devices are intended to help improve outcomes for the user. But a commitment device in a trading setting can be harmful. To commit to a hold on to a particular stock at all costs, which is what we saw during the meme stock phenomenon, directly conflicts with the concept of stop loss, which is an important risk management technique. Another item which I'll share is just the one above that, fractional share trading. From a behavioral standpoint, we think fractional share trading is a good thing because it counteracts what behavioral scientists call nominal price illusion, or a belief that low price shares are also tend to be undervalued or more likely to appreciate than high price shares. Like, because of fractional share trading, there is a fractional share trading in effect counteracts this nominal price illusion, which is a positive. In Can we move to the next slide, please? As Paul said, we did an investor trust study, and I wanted to highlight a couple of survey findings from our biennial investor trust study. In this study, we surveyed more than 3,500 retail and 976 institutional investors across 15 markets, so it's a global study, on their overall trust in financial services, the drivers of trust, investors' use of digital platforms, and their opinion on gamification and cryptocurrencies for that matter. So, what did we find? Can we move to the next slide, please? One finding is that younger investors use digital trading apps more, which is not surprising, but across age groups, 1/5 of the users self reported entertainment or speculation as the primary reason for using a retail trading account, with other 4/5 citing investing to meet long term goals as the primary reason. Now, almost all investors derive pleasure from trading. I mean, they like to talk about the bets they made, the calls that went successful, discuss it with them over water cooler and things like that. Almost everyone derives pleasure from trading. What we find is 20% of users that entertainment reasons dominate what you would call rational reasons, right? And what is also surprising is that while the number of older users who use digital trading app, or a percentage of users who use older users using digital trading apps might be smaller than younger users, an almost equal proportion find digital trading apps to be entertaining, and that's the motivation for them using it, which I thought was pretty interesting. In the next slide, what we also find in this study is that a majority of retail investors said they trust digital nudges. I think that kind of jibes with many of the previous comments that we heard from Jasmine and Melanie. They trust digital nudges. They believe that trading apps enhances their understanding of investing, but they also find that the use of apps increase their frequency of trading. Now, this is not an experimental study which some of the other academics had conducted. Like, for example, in a experimental setting, what happens when you introduce gamification? And what they found was it increases their frequency of trading. This one is purely self-reported. We asked them, do you believe that the use of apps increase your frequency of trading? And 57% of global retail investors who use trading accounts said yes. And that number is almost 75% for the investors aged 25 to 34, and only 10% of older investors or 28% of investors above 55 said that the use of nudges increases their frequency of trading. Now, I think it's a good thing that engagement potentially improves learning, but what it also means that when you trust those nudges, you are less likely to be skeptical of the underlying intentions of the brokerages, which also explains their increased uh, frequency of trading on a self-reported basis in this case. Can we move to the next slide, please? I would like to conclude with some of our recommendations in the paper. We actually made 9 recommendations for regulators and firms in the area of principles, disclosures, and conduct. Some of the recommendations are based on our observed practices of brokerages, not only in the US, but also outside US. So including in my home market, India, we observed some practices which were good, and we thought that that could be interesting as a basis for some of our recommendations as well. Our main recommendation is that app design should include features that allow for review and reflection by users. Now, one of the issues with app design is that it encourages automatic intuitive thinking, or what we call system one thinking, to use the words of Nobel laureate Daniel Kahneman. We urge interventions that help traders slow down and think about consequences. Now, for example, one of the examples could be use of third-party authenticators for validating transactions in penny stocks or meme stocks, which is actual practice in one of the Indian brokerages. Moving away from one-click ordering to an order review confirm system. All of these things introduces a little friction without taking away user choice, and that's what we are striving for. Another recommendation is that reward and feedback systems should focus on long-term investor outcomes and not on transactions and short-term outcomes. A problem with regulating confittees is not the confittees themselves, but it rewards underlying transactions, which is short term, rather than like rewarding a long term outcome. Even though you would imagine that, confittees are like, a very superficial reward. The problem is that it rewards instant gratification and not long term outcomes. So, one of our principles in our report is that look, the reward and feedback systems are not the problem. The confidence is not the problem, but what they reward, that's the problem. Can we move to the next slide, please? I think Jasmine talked about point of transaction disclosures in plain language and the power of point of transaction disclosures. One of the practices we found outside the US is in India, which allows transactions in companies that have entered bankruptcy. If you go and put a transaction there, trading buy or sell order, buy order in one of the companies which are entered bankruptcy, the app says that look, there is a high likelihood that you will lose your entire capital on this trade. Do you wish to continue? That's very powerful point of transaction disclosure, right? So there could be other examples as well, but I think that's when user attention is the most, and that's when disclosures have the maximum impact. And the other thing is disclosures must take into account the medium through which they are consumed. I mean, if you have seen terms and conditions on a mobile device, I think you are most likely to not read it or skip it more than if you had seen those terms and conditions on a laptop or even a piece of paper. So disclosures must be optimized for mobile devices in particular. Can we move to the next slide, please? The last, only other recommendation which will highlight is warning label for brokerage communication. I think in our report we encourage health warnings for brokerages along the lines that excessive trading is injurious to financial wealth. I think brokerage advertisements in recent years have become too rosy. I think it doesn't it's not neutral. I think warning labels can counteract some of the rosy messages that are there that we see in advertisements. In many jurisdictions outside the US, regulators are considering, warning labels such as more than 90% of retail investors have lost money in crypto or lost money in derivatives. Those kind of warning labels are also considered in many jurisdictions. And we think that, in addition to gamification technique, you need to look at the whole spectrum, including advertisements. So I'll stop there. Thank you for, allowing me an opportunity to present the remarks, and happy to take any questions. Thank you.
Thank you, Siva. Appreciate your comments, and we'll circle back with questions. At this point, I want to move to James Tierney. James, your scholarship is focused on digital engagement practices and securities regulation. You study trends in retail investing and app design on investor behavior. Can you discuss your findings and provide your perspective on whether or not regulatory intervention is necessary to protect investors?
Sure. And let me begin by thanking you all for the opportunity to talk with you today. So these remarks, as well as some kind of written remarks that I've included, along with the agenda for today's meeting, focuses, as Paul was saying, on how law encourages, shapes, and constrains retail investors' participation in kind of the use of stock trading and investment advice. And my remarks today are mostly going to focus on broker-dealer regulation, but I have a couple comments on implications for advisors and kind of the use of some technologies like predictive analytics more broadly. I should just say at the outset, there are some issues I probably won't get to in my main oral remarks, but which are discussed kind of in the written stuff and in the scholarship, like going over some of the scholarly evidence about how gamification can affect investor behavior. So I think it's probably worth picking up, midway through at least kind of my spiel on this, and thinking about, organizing different visions of gamified investing apps, and then moving into, what does the social welfare analysis look like, and what do some of those regulatory interventions look like. So if we can jump ahead to slide numbered 12, which says alternative visions of, you'll get to see all of my fun memes. There's a Simpsons screenshot in there. As it turns out, many of my students are young enough not to have really grown up with the Simpsons, even though I think it's still on. We all do what we can. So, we've heard some of our other, from some of the other panelists, as well as commenters on the DEP request for information, reflecting some concerns about gamification and digital engagement practices, the sorts of things that maybe make people trade more, some of the aspects of the underlying business model that, lead to all of this. And in general, I think the comments we've heard so far are, maybe a mixed bag, somewhat hopeful, but recognizing risks for investors. And I think this reflects that skepticism of DEPs is not the only game in town, right? There are a couple of other ways that we can think about gamified investing, which I want to briefly discuss before turning to some of the regulatory implications and thinking about how we can intervene. So one school of thought thinks of this from kind of a populist perspective that I think has not, really gotten an airing on today's panel. This is the idea that it might be good to gamify corporate governance, right? There's rational retail, kind of shareholder apathy with respect to shareholder voting, shareholder governance. And if we can potentially make it easier to participate in those processes, that might be plausibly good, right? concern with this is that you might see the similar sorts of shareholder drive for growth in returns just mediated through Reddit rather than through private equity funds. A second view is kind of techno-skeptic, and you've heard, I think, some threads of this, right? That it's bad not only for first-person waste and loss issues. I'm sorry. I think I actually have this on the wrong slide up here on the screen. I was looking at my other one. Can you move, I think, two ahead, maybe? Yeah, there we go. Thank you. All right. I appreciate it. Thanks. And we'll just move forward from here. The skeptic idea is that it's bad to make trading like a game. People suffer idiosyncratic losses, right? There might be disconnects between asset pricing leading to bubbles, right? Do market prices reflect fundamentals? Is that even a question that we can ask with respect to certain kinds of crypto asset securities, for instance? If markets are broken, the counter argument might say, isn't it good that people maybe realize this and we start to think about, are markets as currently designed and operating working for the purposes that we're supposed to have them? The last view that I want to return to at the end of my remarks today is this kind of techno-optimistic view. The idea that we might be able to harness certain kinds of digital engagement practices to solve the problem of financial education and financial illiteracy and innumeracy, right? The problem is that gamifying education is hard, as we'll see. All right, next slide, please. So some of the scholarly evidence, which I've not discussed in my remarks today, but it's cited in my comments for the record, including my articles in Duke Law Journal and Yale Law Journal Forum. This scholarly evidence suggests that app design may influence behavior in ways that induces trading in securities that have become kind of newly salient or newly at the front and center of retail investors' attention. So this might encourage people to trade more than they might otherwise, in particular stocks that are kind of more salient to them, regardless of the reasons. Is that something securities law should be concerned about? And on the flip side, are there implications for the kind of judicious use of DEPs in making people more kind of economically responsible and rational? And if that's where we're going, is that even the goal of the securities laws in this space? All right, next slide, please. So just to briefly run over a couple of the plausible benefits, right? DEPs may well make investing more fun. I can personally attest to that. It might relatedly make it easier to access capital markets, make that more widespread, right? Reducing transaction costs, increasing people's ability in a capitalist economy to build wealth. And other scholars have, as I mentioned, noted this kind of plausible benefit that making investing fun might solve some of the collective action problems associated with non-voting. Next slide, please. But as I think you've heard in some of the other comments today, there are plausible harms from gamification too. As we've heard, people getting distracted into buying stocks just because they're salient and not because it's a good buy, that leads to a plausible misallocation of capital. Stock markets are meant to help finance good projects in the real economy. And if, we're kind of allowing technology to push capital away from kind of good allocative uses that grow the financial, from good projects into ones that grow the financialized economy, that might be a reason to be skeptical about the allocative role of capital markets and how the role of retail investors in that space. Other harms, there's evidence, including, from the data that used to be, investor transaction level data that used to be available from Robinhood, that certain kinds of short-term retail trader strategies might be profitable, but that on the whole, active trading isn't. Certainly, for many investors, things like margin trading, options trading, it's going to blow up in many investors' faces. So the more they trade, the worse they do. There may also be secondary effects on traditional financial indicia of market quality. So if it turns out that retail investor traders, systematically increase the volatility and widen the bid-ask spread for stocks, in response to certain kinds of digital engagement practices, then that would have other effects on the market as well. We might also be concerned that some of the promised benefits, of educating and building engagement or of encouraging corporate governance gaming, those might not materialize either. Okay, next slide. So I guess I come down on the side of the SEC intervening to correct some conflict of interest issues that drive this space. And if we think there might be regulatory intervention, what does existing law say and what is to be done? All right, next slide again. Thank you. So one option is to just ban gamification and digital engagement practices, right? As my colleague from Nebraska, Kyle Langvart, and I argue in an essay about a year ago, this solution faces some definitional problems, right? What is exactly the sort of DEP of objection to us? Is it the push notification? Is it the confetti? Is it the machine learning that learns how I respond and then kind of tailors its interactions with me to get me personally to trade more, right? I mean, so there may well be kind of a spectrum of DEPs, and defining what is objectionable might have regulatory definitional problems. There might also be First Amendment issues that raise litigation risks as well. Okay, next slide, please. The more standard doctrinal interventions, right, are some ideas. There are existing laws that try and get at brokers' conflict of interest, which is to encourage trading to the extent that they get compensated on a transactional basis, right, based on how much you trade. And so one option is to fulfill one of the mandates of Dodd-Frank to harmonize. Or I should say, finish the business of Dodd-Frank's mandate to harmonize the standards of conduct for BDs and IAs. And federal intervention in this space might be particularly welcome, as I think states have struggled a bit here. Some of the difficulties that the Massachusetts state securities regulator has had in pursuing and kind of adopting state fiduciary duty regulations that would cover gamified investing. There's some litigation about whether that kind of goes too far beyond both what the SEC and what kind of state common law fiduciary duty doctrine would have permitted. So that potentially highlights the role for leadership at the federal level. Another option is to tinker with sales practices, which we'll actually discuss in about 30 seconds. But some other DEPs may be subject to anti-fraud and manipulation issues as well. Chair Gensler's remarks about market participants using sentiment analysis this morning, right? If we know, for instance, that algorithmic traders, are mining textual sentiment on Twitter or seeking alpha or something like that, one consequence is that we might see posting bots trying to alter the sentiment on those platforms. It may be that legacy fraud or manipulation doctrines might be able to cover the kind of trader participant fraud and manipulation, but you might also think capaciously about the ways that those legacy doctrines might cover, the design and deployment of DEPs as well. The last kind of doctrinal intervention that I think is worth mentioning is compliance, which is a key regulatory technology. Adding some sort of compliance element here is kind of what we saw with the proposed federal reg best execution proposal, as part of the equity market structure reform package. The key feature of which is to have, written supervisory procedures that would, be reasonably calculated to, I forget what the exact language is there, but the analogy here would be to kind of calculated to prevent certain kind of regulatory violations of the substantive provisions also being adopted. The idea here is with this sort of compliance technique, you can catch compliance problems where you're not saying what you're doing or you're not doing what you've said you're going to do as part of your policies and procedures. Having a compliance framework for this might also deal with some of the broader issues about bias in inputs leading to potentially discriminatory outputs, a big problem in, thinking about AI and AI ethics, as well as, ensuring that maybe we're auditing and updating our algos and our other code over time. Next slide, please. I mentioned this idea of brokerage sales practices rules like reg best interest. This has come up a couple times on the panel today. This sort of rule requires brokers to have a reasonable basis to believe, with respect to retail customer recommendations, that a pattern of trade that you're steering a customer into is in the best interests of the customer. And the comments from Melanie with the Miami Investor Rights Clinic like raises this idea of expanding the definition of a recommendation. This idea that but for the enticement, the customer wouldn't have traded. I am very sympathetic to that approach, but I always come back to the practical brass tacks. How is enforcement, or how is OC going to monitor for that? How are they going to enforce it, right? How can you have a team at the SEC assessing based, or a team with kind of PIABA, right? Plaintiffs lawyers assessing baseline customer behavior, and then what they would have done but for the enticement. I do like the idea of defining certain kinds of defaults, like Jasmine suggested with respect to, I think it was margin accounts, right? You could cleanly define some areas of recommendation that way. Another upshot from comments earlier on the panel was with respect to disclaimers by firms that what they are or aren't doing is making recommendations. In general, the SEC has been very clear in interpretations, the longstanding interpretations of the kind of pre-Reg BI suitability rule, that disclaimers that you're not subject to the suitability requirements are not enforceable and not binding on the commission. The last thing I want to mention is this idea with respect to how to handle self-directed accounts. This is an area of related concern to what I've just been mentioning, because Reg BI doesn't apply without a concept of a recommendation, which I think raises some of the stakes of defining things as a recommendation. And it also raises further questions about whether we should be promoting what Jasmine, I think, called the traders, right? If we're thinking about frameworks for helping self-directed traders, the best interventions, but probably the least politically saleable ones, are those that get them to stop trading. Other options that securities law sometimes focuses on include disclosures. The problem of these, of course, is that no one reads. And if you get a push notification with a disclosure, as you do with the terms of service on WebEx, as you signed in today, you're going to click through and accept. Next slide. The last thing I do want to kind of mention is you could have a more ambitious effort to reform some of the market structure problems that give rise to incentives to encourage retail investors to trade noisily, get at some of the underlying conflicts of interest by banning PFOF. I think in the interest of time, I'm probably going to skip over this, but if folks want to talk about everyone's favorite topic, equity market structure reform, in the questions, we can do that. The very last thing I do want to say, I'm miscounting here, and next slide, please, is some closing remarks on how we might think of the flip side of what has mostly been a skeptical take on broker-dealer DEPs. You could think that there are a few optimistic or pro-social uses for DEPs in this space, right? Predictive analytics, machine learning can sift through data, identifying patterns, informing investment decisions. And, this ties in with the idea of robo-advice. You can potentially shift households who are notoriously irrational in their financial behavior toward what traditional normative finance would be encouraging them to do. Relatedly, the use of some of these tools can provide more personalized investment advice tailored to individual goals, risk tolerance, and things like that. You also might be able to, through the use of DEPs, either provoke or restrain emotional responses on the part of clients, which might influence investor behavior. The difficulty with kind of the financial education aspects, although it does give rise to some optimism, is that meta-analysis of financial education interventions suggests that it's existing endowments of financial literacy are sticky and hard to change, especially in the long run. So this gamification pulls at a lot of normative threads in the securities laws, and I think it raises important questions of what investor protection means in an era of self-directed investing. Thanks for the opportunity to share remarks with you today, and I look forward to your questions.
Thank you, James. Appreciate those comments, and we'll get back to some of the issues that you raised in your comments. I did want to note that again that Algernon Austin couldn't be here. He had an emergency come up first thing this morning. He apologizes for not being here. He did provide a statement that we will put in the record, but Algernon was going to really focus on the impact of targeted marketing, particularly in the cryptocurrency space. And you'll see his paper that's posted on the website, which basically indicates that he focused on Black investors in cryptocurrencies and analyzed some cryptocurrency investments and returns, and basically concluded that over a 5-year period that investors would have been better off in index funds for the most part. So you can take a look at his material there, and then we'll post his more specific statement on the Investor Advisor Committee website. But again, good discussion. Before we open it up for questions, I wanted to start out with just the fact that the Commission's Reg Flex agenda that Chairman Gensler highlighted, that he has on the agenda proposal that would prohibit conflicts of interest in connection with the use of predictive analytics in the case of broker dealers and investment advisors. I just wanted to throw out for the panel conflicts that you think the Commission should address in that proposed rulemaking. James, you sort of alluded to payment for order flow as a conflict, and there's certain platforms that their business model compensation largely comes from the payment for order flow. In certain countries, in the UK and Australia, I believe they've actually banned or severely restricted payment for order flow. So I really just wanted to get thoughts from the panel on conflicts in this area in terms of digital engagement practices, use of predictive analytics, and where you think the Commission should focus its attention on those conflicts. Anybody want to start?
Paul, if I can, make one comment.
Sure.
So I think, predictive analytics, I'm thinking, within brokerage apps. So one of our recommendations, which I did not touch upon, is research on stocks must be based on reputable resources. I think what we were alluding to is, brokerages, including in the news feeds of brokerages, including, increasingly use AI. So essentially, you start trading meme stocks, you will suddenly see positive news stories about crypto, positive news stories about SPACs and things like that. That's because, AI learns, these people who trade this might trade that. Therefore, it starts, prioritizing certain news feeds. So I think we said that it cannot be based on, or just an AI-based news feed. It actually needs to be based on reputable news, research, right? So I think, that kind of ties to the predictive analytics portion a bit.
And if I could add on, as I mentioned in my comments, I think the disclosures are really important in addressing conflicts. Certainly not buried in the fine print, very easy to understand disclosures. Some customers may be fine with zero commission trading in exchange for selling data for advertising or for order flow, but they may not understand the implications of that. So if, that means that they might get a worse price, but it's, only slightly worse, but overall they're better off with the zero commission. It seems like that should be a decision that an investor should be able to make, an informed decision. And I think a lot of the problems have come about from these conflicts, not being disclosed and not being well understood until, there's a commission action dealing with it.
Yeah. Thank you, Jasmine. Other thoughts? I know, James, you have, in reading some of your law review articles, you questioned the effectiveness of disclosure. And I know that's, fundamental concept in the federal securities laws, but do you have a sense that disclosures are effective in this space?
Yeah, so So I appreciate that question. One of the mechanisms of disclosure that makes it, kind of fundamental through the primary and secondary markets that we think of as the kind of core mission of the SEC is that there may be some non-readers, some non-consumers of the disclosures, but the efficient markets hypothesis, kind of underpinning for why we have kind of open market reliance in securities fraud class actions, for instance, is that we assume that there are other people disseminating those disclosures out into the market for us, protecting through that mechanism and impounding that information into the stock price, kind of protecting non-readers. In the context of, kind of individual atomized retail trader interactions with a financial advisor, either a BD or an IA, you don't have, the kind of distinguishing consumers on the margin who might be able to drive bad practices out of the market, which I think raises some stakes for thinking or maybe rethinking the primacy of disclosure in this space. Just to briefly bring that back to your original question, though, with respect to you could disclose certain kinds of conflicts of interest, right? But this is a longstanding debate about how we should deal with, kind of conflicted transactions in Reg BI. Should we be able to disclose them away, or should they be prohibited entirely? Two different models of regulation, and I think what you see in, at least if you take a look at the equity market structure reform proposals, is trying to minimize the role of payment for order flow and other kinds of agency costs without getting rid of it entirely. And I leave to the commission whether that goes far enough in this space, but it does reflect this trade-off between these two options: ban versus disclose. And the disclose option, I think, really depends on your confidence in the strength of those mechanisms.
Good. Thank you for that, James. Let's open it up to questions. I think, Cambria, you had a question.
Yes, no, thank you. And thank you so much to the panelists. This has been great. And please bear with me here with the question. I just want to go back to the first presentation. There was a point about rewards or awards of cash that can only be used in the app itself. I'm assuming to just encourage additional trading. But just curious, if there are any concerns about the legality of that. I mean, it sounds like it sort of sounds like they're getting tokens that they can trade with later. So that's kind of what I'm curious about. I think it was Professor Cherdik that made that point. So hopefully that question.
Yes.
Yeah, go ahead.
Yes. So I regularly, because I'm interested, I have several trading apps on my phone. So I can know, what's new, what's fresh. Our students always want to talk about it. So I want to make sure, that I'm up to date with whatever's new. And this was something I happened to notice a few weeks ago that kind of alarmed me, right? So an unnamed trading app has a way where you can get a linked debit card, and you round up to like the nearest dollar any purchases that you're making. And that differential is then put in your trading account, right? And this unnamed firm will match that differential up to a certain amount of money, but it needs to be used to make trades. So, the name of the game when you're dealing with payment for order flow as a business model is generate trades, generate cash for trades in any way that you can, be it using a margin account or, buying fractional shares of securities because the accounts are historically lower, the average account size. And so, my personal feeling is that I have no idea what the legality of it is. I'm sure it's been very vetted by whoever created this program, but everything in these apps is geared towards, this is my opinion, increased frequency of trading. by any means possible. And you know what? That is the inherent conflict of the payment for order flow model. And there's no way of getting around it. The disclosure of that to clients or investors doesn't deter investors from using this type of trading app because all they care about is, hey, I'm getting a commissionless trading, right? They're not thinking about the nuances in it, whether it may or may cost them more in terms of the VIG on putting that payment through a third party, which has been studied, you know, and sometimes yes, sometimes no. But I personally don't think that the disclosure of that inherent conflict gets rid of the problem because people are still, yes, they might get the disclosure, they may or may not understand what it means, but it's just a business model itself. I think that's why some countries have gone the way of, you know, not allowing this type of business model. So I hope that answers your question.
It does. I mean, it just seems like almost a bit of an additional step that I hadn't it hadn't occurred to me at all. You know, maybe we might want to consider as well if that's, you know, kind of beyond encouraging additional trading. It also seems like it's something that someone's getting a value that can be translated into dollars off of the app. If they're, you know, if they gain
I
return or
think it might
something, is
just,
that?
I haven't engaged in
Oh,
it.
okay. All right.
It
I'm
just
curious.
be an actual, not a coin or a token or anything like that. It might just be you're given that amount in cash, but it's in a specific account.
Gotcha. Okay.
But I don't know because I haven't used it.
Okay. All right. Thanks.
Christine, I think you had a question.
Thank you. And thank you to all the panelists for the information and in particular, the information about all the studies that have been done on these issues. In my clinic, we often get complaints about trading apps, but there's a lot of consistency in the issues that the people are dealing with, and they generally relate to particular products or practices like options trading and margin trading. And so my question is there any thought as to whether or not, in terms of addressing the EEP issues, whether it would be more appropriate to do so on a platform-wide basis, or if there are particular aspects or products within the platform that should be targeted for further regulation or additional protections or disclosures?
Anybody have thoughts on that?
Yeah.
So,
Sorry, Civic, you go ahead.
sorry, very briefly, I mean, like, you know, I mean, I'm from India, and like, you know, we have the world's largest derivative market, and believe it or not, right? So you know, and it's crazy, right? It's just a reflection of the kind of you know, speculation that's out there. And I think the example which I cited, right? You know, so one of the research which SEBI, our markets regulators, put together is like look at investor accounts and try to figure out what percentage of retail investors actually make money, right? And how much they lose money and so on. I mean, almost all of them lose money. And then they said, okay, fine, like, you know, okay, fine. They didn't do it as part of the brokerage regulation, but they did it as part of the advertisements. So like, and I think they're thinking about like, okay, fine, can this be part of, you know, advertisements, like, you know, can you introduce that line saying that, okay, fine, by the way, more than 90% of investors lose money in options trading, right? So I think I don't know what's the right way to kind of regulate this, but that's just one way.
James, you had a thought?
Yeah, I would just add, you know, I think of these kind of categories of regulatory intervention as having different kinds of scope, right? So there are some firm-wide, platform-wide rules like the FINRA communications or advertising rules, right? That would apply kind of to the broker dealer and to all kind of interactions potentially on the app. Right? But then you can also think of other ways of handling it. So like you might have a complex products vertical with respect to certain kinds of regulation. And that might raise different sorts of questions, right? What I think may underlie your question is a bit of concern about whether retail investors who kind of are susceptible to these practices should even be in the complex products, options trading, margin debt space, right? And if that's the case, that is probably more like more going down the road of merit regulation and starts to look less like some of the canonical interventions here. That doesn't mean I don't think the SEC should do it, but it just starts to look a bit more far afield.
Thank you, James. Ted, you had a question?
Yes, I had a question. I guess we can start with James, but thanks very much. This has been very useful here. All the speakers have shared great information. My question is associated with, and I think you had on one of your slides, James, about financial education. Does it make sense to have protocols associated with a particular transaction before the person has the ability to execute the transaction?
So just
protocols of knowledge, protocols of knowledge associated with the particular transaction they're about to take.
Yeah, I mean, I think it's an interesting extension of what I was just mentioning a moment ago. This idea that if you think of certain categories of trading behavior as problematic, and I don't want to put words in your mouth, but suppose that you think that retail options trading or retail margin trading is potentially problematic, then you might do something that looks like restricting access to those sorts of products on the basis of tests. And that's actually something that the SEC has contemplated before, right? The recent accredited investor reforms in 2020 included these ideas, and there's kind of been long-standing debates about whether we should expand even further. The idea that certain kinds of professional certifications allow you to become an accredited investor. And so I don't think it's a far analogy to say that before you do certain kinds of really risky trading behavior, you should show that, you're either sophisticated enough or something else. There are problems. If you do a test, the test, results can be leaked or, it can be gamed or whatever. But that seems to me to be questions more specific to the objectionable trading. But I agree with you that from an implementation perspective, you might be able to link it at like the broker level so that, you're showing that you have sufficient knowledge or engaging in some other kind of engagement practice to establish your sophistication might well be enough. And that would probably get rid of some of the concerns that have been expressed about these products.
Yeah, I think so. Yeah. Okay, that's good. Thanks, Paul. And thanks, James.
One of the, I think issues that's highlighted, by this whole area is, and I think, James, you've written about this, that, you have Reg BI that's, where broker-dealers are making recommendations and Reg BI kicks in. For advisors, you have the fiduciary duty obligation, but you have the self-directed investor who's out there, and if they're in a context where there technically is not a recommendation, should more be done to protect those self-directed investors? Should there be additional requirements imposed in terms of monitoring those accounts by the broker? Ted sort of, alluded to, know your customer. Are there additional requirements that the SEC should think about to protect self-directed investors? Because it's kind of been an area that, there's not been much to address those investors.
That's right. Yeah.
Anybody have thoughts there?
I mean, we do have, certain requirements already. FINRA has certain requirements around options trading. There are some hoops to jump through, and firms have gotten in trouble when they haven't implemented those properly. I do think, like we talked about earlier, the defaults are really important. Not all the defaults make sense for certainly all investors, and perhaps, defaults should be a little bit more on the cautious side, certainly, than on the riskier side. So some defaults might be convenient. It might be convenient to access margin, but maybe that isn't the best default to have for everyone. Maybe to get that as your default in a way, it's not a default. Maybe you need to kind of, show that you're a particular kind of investor to get that, or actively choose it and satisfy certain criteria.
I came across an UK FCA paper on gamification and what they were thinking about this. I think their thrust of their arguments, I think they have something called a best customer duty or rules that are coming in either this year. I think it is this year. So effectively what they were saying is, okay, fine. Brokerages have a duty to identify their most vulnerable customers, meaning some customers exhibit sort of gambling sort of behaviors and so on, and brokerages cannot simply sit back and let them overtrade like to extinction. So they in fact have a duty to kind of identify the most vulnerable customers, like potentially because of their actions to start with, right? So I think, like, I don't know how far SEC will do. Different jurisdictions have different philosophy for regulation. I think I don't know if each, like, just because FCA did something or SEBI did something or something, it's just going to get follow that this thing. I'm just telling you, like, there are different approaches people are considering.
Thank you, Siva. Appreciate that. We talked a lot about, broker dealers on the advisor side. Are there issues? We talked about robo advisors. Jasmine, you talked about robo advisors. And again, going back to the question of conflicts that a robo advisor may have, you talked about the benefits of, robo advisor, lower cost investing, how investors have benefited. But are there conflicts that commission should be calling out and addressing with regard to on the advisor side, do you think?
I mean, the commission has done a good job, certainly, with the cash defaulting. There was some enforcement actions, I don't know if it's enforcement action or investigation, but yes, they have called out defaulting into cash, and there was a conflict of interest there, so really very much related to the themes we've talked about. I mean, it was working under current law. I mean, I think the fact that it was gone after under current law shows that it may not be an issue of new regulation. The investment advisors have a fiduciary duty. They know what they're supposed to be doing. And so some of this stuff may be tricky to discover and enforce. And I'm not an expert on how to do that, so I'm not totally sure what to recommend there. But I do think, it's we'd have to be cautionary, because on balance, robos have been very good for investors, and so I wouldn't want to see something so broad that it would deter saving. That would be the concern.
Yeah. I know on the robo advisor space, I think you're right. There've been some actions and around hidden costs and lack of disclosure of cost in that space. Any other questions?
Yep. Paul, you got a few hands up.
Okay.
I have a quick question, Paul. I'm wondering if anyone can address if there's any particular platforms or maybe there's platforms that then have affiliated education platforms for minors. The reason I ask is we kind of know how this is all unfolded for teenagers in other digital engagement arenas, and I'm just super curious to understand what the formation of these might be with I'm sure platforms that aren't explicitly targeted to teenagers, but that are essentially for younger people. I mean, I know I've definitely seen some that are like, banking and sort of very minimal investing to teach your kids how to be responsible with their money.
Christina, I have kind of a related question that might extend yours a little bit, and that is the question of whether all these vulnerable investors really can be lumped together. When you think about vulnerable investors, there's really our more elderly investors are more world wise and financially savvy on average, but less technically savvy. And our younger investors are more technically savvy and less educated in terms of the way the markets work. So you're talking about, these kids who are used to lots of, the gamification of they get points in the video games, and
Right.
they get those mechanics, but they have no idea what it means to, go short on a stock on margin,
And they wouldn't have
and
a lot of money, whereas an older investor would. But I presume the flip side is I could probably, if I could form some behaviors at a younger age when they do have a little money, I could probably have them on my other platform all day.
So, do we need to think? I would ask the panel: do we need to think about these as different solutions for different? I mean, to me, the problem of a lack of financial sophistication is actually a fairly distinct problem from the lack of technical sophistication. Those are, they're not unrelated in terms of the consequences, but they're actually kind of different to address. And Paul, the other comment I would make, and I don't know if anybody, it's an interesting thought experiment to ask yourself how these platforms would behave if their compensation structure was a percentage of profits generated by their users. Now, obviously, that's a hypothetical thought experiment, but imagine what kinds of coaching Christina's 18-year-old hypothetical kid would get if the only way the platform made money is if that young trader was actually profitable in his or her trading.
Introducing performance fees in the digital platform space.
I had a I had a comment. I don't know if it'll
Yeah, Siva.
fully this thing. So the I don't know if we need different platforms, but I think if you have to reach young investors, you need to follow what the successful influencers do, but without the conflicts, right? I think the methods are fine for reaching the young investors. It may be the message is a problem, and I think whether it's SEC or whether it's our own regulators here. I think they when they reach out this when they reach out to on social media, I think something falls apart, right? When it comes to how they reach out to this thing. I think it's more like FT Alphaville once made some funny meme of what SEC was trying to do when it comes to crypto education on Twitter or whatever, right? So I think I think the people who have the best intentions need to marry it with the people who have the best methods to reach, which is unfortunately today the influencers who have millions, right? I think they have gotten the methods right. It's just that the message needs to be done well. I don't know if we need a separate platform altogether for reaching out to young investors.
Good. Thank you, Siva. We've hit our time allotment, and I'd like to thank each of our panelists for making the time to participate, generating the materials, which were excellent, great discussion. Siva, thank you for staying up all night to be with us from Mumbai. And at this point, I'll turn it back over to you, Christopher.
Paul, thank you so much. And let me, on behalf of all the IAC members, join you in thanking that excellent panel. That was a very, very interesting discussion, very important discussion, and really appreciate all of you making time for us and helping us with this issue. All right. I'd next like to call on James Andrus to introduce his panel relating to audit committee workloads. James, are you locked and loaded?
Thank you very much, Christopher. In October, Chief Accountant Paul Munter indicated that the Association of Certified Fraud Examiners estimates that organizations lose 5% of revenue to fraud each year, an estimated loss of $4.7 trillion on a global scale. In addition, our own Colleen Honingsberg, in her paper, Forensic Accounting, noted that roughly 10 to 15% of companies on an annual basis have some sort of financial reporting misconduct. These numbers were, in fact, supported by the paper How Pervasive is Corporate Fraud by Dick Morse and Zingales. This highlights what the problem appears to be. Before you today will be a discussion on the role of audit committees given the pressures that they face currently. This includes the PCAOB is currently looking at updating the rules. Interestingly enough, after 20 years of operation, the PCAOB still has some interim rules which were in fact adopted by the industry. That means auditors' rules are in use. The PCAOB is progressing in updating those rules, which brings additional pressures not only on auditors, but on audit committees. Today, we will hear from Lauren Cunningham, an academic, in a presentation to discuss the kitchen sink of the board. We'll also hear from Vanessa Teitelbaum in a presentation that highlights some of the work of the Center of Audit Quality. Finally, we will have a panel discussion among some of the most significant leaders in business and accounting. This includes Robert Hertz, David Herzog, Anthony Anderson, and Sheila Huda. I will introduce each participant immediately before they speak, and I will introduce the panel right before we start. To kick us off, Lauren Cunningham is the Keith Stenger Associate Professor of Accounting at the Haslam College of Business at the University of Tennessee. She received her PhD in accounting from the University of Alabama. Her research interests include financial accounting, auditing, and corporate governance. Specifically, she focuses on audit committees and financial reporting quality. Lauren gets to kick things off with a discussion of Audit Committee, the kitchen sink of the board, written by Lauren, along with Sarah Stein, Kimberly Walker, and Cornisha Wolf. Lauren?
Thanks so much, James. So to provide some background on this presentation today, and I think they're going to put the slides up while I'm presenting. Perfect. Thank you for that. This research project we endeavored on because we had been reading about audit committees taking on evolving responsibilities. And as accounting professors, the audit committee is one of the key committees in our mind of the board. And so we wanted to better understand why is it that certain audit committee members are taking on expanded responsibilities while others do not. And then we also wanted to know, what do audit committee members think about their proxy disclosures? So what gets disclosed in the proxy statement related to their oversight responsibilities? Here you can see a summary of the participants that we used in our research study. We used qualitative research methods for this, which means we interviewed our participants. We interviewed 30 audit committee members. 25 were in the chair position, 5 were members, but the members were longstanding members of their company's committees and could speak at length about operations within the committee. They were diverse in terms of their gender, in terms of their age, in terms of their experience as an audit committee member. They also had served at multiple public companies, not just the one that we were interviewing them about. Many of them had that traditional background in external public accounting as auditors. Many had gone on to be in firm leadership roles, but we purposely sought out diverse career experiences that might be represented on an audit committee. So we also made sure to speak to audit committee members who had served in the CEO role, CFO, private investment. We also made sure to get diverse industry representation and diversity across company sizes and their different governance structures. As we went through these interviews, it became apparent that we weren't going to get the full story just talking to audit committee members alone. And so we expanded our interviews to also interview 5 preparers of proxy disclosures, 5 professionals from investment firms, 2 proxy advisors, some analysts, a corporate governance research firm, and professionals from shareholder advocacy groups. Next slide, please. In case you're not already familiar with the types of responsibilities the audit committee members are currently taking on, I wanted to first show you some survey results. This is from a different study, not ours, that's co-authored by the Center for Audit Quality and Deloitte, a very recent one, 2022 survey data, 164 audit committee members participated. And what I've done here is I've drawn a box around audit so that you can see, and I know the numbers might be quite small for you, so I'll point them out to you. What I'm hoping, and I use some color to bring your attention to it, what I'm hoping that you see here is that if the oversight responsibility area is not taken on by the board at large, it's coming to the audit committee. So among the different committees that you see here, the audit committee is the one taking on an increasing amount of workload. And it's not just related to financial reporting topics that we've seen traditionally. We're seeing 43% of audit committee participants said that they are the ones on their board primarily responsible for enterprise risk management, for example. Same for third-party risk, which I think today's panel might touch on that topic a bit. We're also hearing audit committee members talk about digital transformation, cybersecurity, data privacy, things that you might not have thought about where audit committee members are taking on more workload compared to other committees, even inflation risk, supply chain risk, and then really hot topic now, ESG disclosure and reporting. Next slide, please. So as I mentioned, our starting research question, the reason that we've even endeavored to do this study was to better understand why is it that some committees take on this responsibility while others do not. Here I summarize for you two key takeaways on why some boards do give primary oversight for these additional areas to the audit committee. One of them is potentially troubling in one regard and the other in another. So these are both areas where we identified something that they said as participants, but we identified some unintended consequences. So 40% of interviewees described the audit committee in terms of words like default, catch-all. We heard the word kitchen sink quite a few times, which is where the moniker for our study title came from. In other words, this is a board where they felt like the audit committee is the place that takes on new things until it's figured out where it should go otherwise. And there are some unintended consequences to this logic. In these cases, audit committee members might not have the proper skill set to oversee these risk areas. Because it's being brought to them as kind of this default mentality, it wasn't brought to them for their skill sets alone. In these cases, audit committee members may feel overburdened, or they may feel like they don't have time for their core oversight responsibility of financial reporting. Or James, your favorite topic, fraud. Audit committee members may also view this as a short-term assignment. And so they might take a check-the-box mentality if they feel like it's just there until somebody else figures it out. In 30% of our interviewees, they referenced their own personal interest for why it came to the audit committee. And we commend these audit committee members. These are highly intelligent, very driven audit committee members who care passionately about these topics. And that's why they wanted it to be with the audit committee. This particularly came up as it relates to cybersecurity and ESG reporting. These audit committee members have spent a lot of time making sure that they're comfortable with these areas, and that's why they advocated for it to come to the committee. But our question to those audit committee members would be, well, what happens when you rotate off? Does your board have a succession plan for that risk if you were the reason that it went to the audit committee? There's also research around overconfidence bias. And so whether or not these boards are thinking about, do we have sufficient other members on that committee that can challenge and help really have a rigorous discussion around this area? Next slide, please. And then I mentioned that there are boards not taking it on, and you can see that from the statistics. Not all audit committees are getting these responsibilities. So why might some boards choose not to give primary oversight to the audit committee for these areas? 30% of our interviewees recalled thinking about where a specific risk should be assigned within the board, and they purposely did not give it to the audit committee because their workload was already too high. And in another 25% of cases, it was discussed. Maybe a bit of that kitchen sink language was used. But in those cases, the audit committee members pushed back on the board and they said, this just feels like it's something that needs board eyes, that more strategic, big picture focus. Or they actively said, this needs a different skill set that's not currently on the audit committee. Next slide, please. And so here's the question that we think today's committee cares the most about. So the Investor Advisory Committee. How can investors assess whether risk oversight is adequately allocated across the board and whether board members have sufficient time and expertise? That's what we think today's committee is interested in today's panel. Next slide, please. When my co-authors and I have gone through proxy statements, and the members of this committee I know have even more experience than we do in this matter, but as it relates to audit committee specific disclosures, we identified 3 main buckets of the types of disclosures that are out there. The first is what we'll call the boilerplate group. James, this is the group we talk about the most. These are ones where I can redact the company name and I can redact the auditor name. And you might think this is one of any company's proxy statements that are out there. So for a lot of companies, they look this boilerplate. You don't learn anything specific about the audit committee. You don't learn much about what it is that an audit committee does. So you have to be well versed in the responsibilities of an audit committee member to learn what it is that they do. You're not going to get that from the proxy statement in these examples. Next slide, please. The second group, though, is what we call the benchmarking group. And these titles that I came up with for today's presentation, they're not the group names that we use in our report. We use different theoretical names over there, but I thought this might be better for talking about what it is that this panel is focused on today. So in the benchmarking group, these are companies that seek to go beyond the bare minimum requirements of proxy disclosure rules, but they're doing so in a way that is still a bit mimicky. So it's almost like a new form of boilerplate disclosures. So the good news is that in these cases, we do learn more about what it is the audit committee is doing, but it's not necessarily in a way that can distinguish from another type of audit committee member. Based on our interviews, the 2 sources that we heard most often for what they use to benchmark in these cases are the Center for Audit Quality's Transparency Barometer report, which you're going to hear Vanessa talk about shortly. It's a great report. And then also EY has some benchmarking data out there. Next slide, please. And then our favorite group of proxy disclosures, these are the ones where you can learn company-specific board practices. So this is where you start to read a proxy statement and you get a feel for the story of what this board is doing, how they're allocating oversight, why they're allocating oversight, how they're going about doing that oversight role. You also get to learn things like details behind director continuing education. And for today's presentation, I know these are all publicly available documents, but I wanted to redact it just so it wasn't trying to call out specific companies, good or bad. Next slide, please. And so at the end of the day, what did we hear in our research? So in our research, what we heard that investors want to see in the proxy statement are 5 different things. First, they want to see improvements in how companies clearly define the allocation of risk oversight for the overall board and the committees. This first bullet item is technically a current disclosure requirement under SK rules, but it's something that I think some companies are doing more clearly than others, and that's where there's room for improvement in even the current mandatory disclosures. The remainder of these would be more of on the voluntary disclosure side of proxy statements. So number 2, explaining why audit committee members individually and as a whole are appropriate for this specific company, highlighting details about continuing education, describing how the audit committee addresses key risks, and discussing more than just external oversight when the audit committee has that expanded set of responsibilities. Next slide, please. And I'm going to conclude today by talking about my last question: why aren't more companies voluntarily expanding audit committee related proxy disclosures? probably the thing this committee hates to hear, but it is what we heard from our audit committee participants. They just didn't feel like investors cared about this topic. So this is something that at least the audit committee members that we interviewed, they feel like they need to hear from investors that the current disclosures are not sufficient. And so this could involve proxy voting guidelines. This could involve policy statements. It doesn't have to be engagement, though engagement for them was the most clear form of communication. And James, I apologize if I went over time, but that's it from me.
Thank you very much, Lauren. Your presentation and your work are exceptional, and so I really appreciate what you're doing. Next, we will hear from Vanessa Teitelbaum. She is Senior Director, Professional Practice at the Center for Audit Quality. She's an in-house expert in resource on auditing and accounting practice issues. She is also the connector for the group you're hearing from today. Vanessa, it is my pleasure to hand it over to you for the Audit Committee Transparency Barometer.
Thank you, James. I appreciate the opportunity to be here to speak to the IAC. I do also have a few slides, if those could be brought up. Perfect. And so I'm very excited to talk about Audit Committee disclosures. I think Lauren and I have that in common. We really enjoyed and appreciate the hard work of Lauren and her colleagues. The kitchen sink report, I think, is a great resource. And it dovetails really well with the research that we've been doing. She mentioned the Audit Committee Transparency Barometer. We have been doing this research in partnership with Audit Analytics. This is for almost 10 years. And so what it is a survey of the S&P 1500 proxy statements and looking at their audit committee disclosures specific to certain factors. And so it started back in 2013, 10 years ago. We published, and this is still out there, and this barometer is on our website too. We started back in 2013 a call to action, and it was to encourage, and we continue to encourage, voluntary disclosures related to the audit committee oversight, and especially factors related to the consideration when selecting and reappointing the audit firm, selecting the lead engagement partner, factors considered when determining the auditor compensation, and the general oversight of the external auditor. And so if we could go to the next slide. Our most recent barometer, published last year, has several components to it. The first is the raw data, and again, we have the trend data from when we started in 2014, and I'll describe the questions in a moment, and it's by indices. And then, as Lauren described, it has examples, which we hope would be helpful, but of course has a little bit of an unintended consequence, as she described the benchmarking. Some companies use it, hopefully, to get past the boilerplate language, but it only goes so far. One thing we did new last year was we provided as Appendix 3 a sample audit committee report, and then hopefully Appendix 4 is helpful because we put in some questions. So, those are really where the committee, working with corporate governance and the corporate secretary, can ask themselves questions to help tailor the disclosures. Next slide, please. So the basic questions that we've been asking since 2014, and these are the results from last year, 2022, by index, and I'll go over these quickly. Q1 is looking at, so that 46% is the rate of disclosure about whether there's a discussion of audit committee considerations when appointing or reappointing the external auditor. Q2 is disclosure of audit tenure. I'm going to skip 2.1 because I'm going to get to that in a few slides. Q3 looks at a discussion of audit fees in connection with audit quality. You can see that one's low, and it always has been. And Q4, which is the highest, I think it's the question with the highest rate of disclosure, is a disclosure related to a discussion of how non-audit services may impact independence. So next slide. So a few more questions. Is there a statement that the audit committee is responsible for fee negotiations? Again, that's kind of a binary question. So yes or no, and it's still relatively low, even though hopefully investors and other stakeholders know that the audit committee is charged with their responsibility to compensate the auditor. Q6, is there an explanation about the change in fees paid? Q7, is it stated that the evaluation of the external auditor is at least an annual event? And then Q8, is it explicitly stated that the audit committee is involved in the selection of the audit engagement partner? And 51% is on the higher side for the things we look at. And I'll talk about 8.1 in a moment. So next slide. So we have found it's helpful to look back at the trend. And this is 2 data points. The blue bar here is 2014. The yellow is 2022. For the most part, you can see there's a pretty good uptick, positive trend in disclosure for the 8 questions that I just described. In general, there's a positive movement there. Next slide. But one of the things we did last year, and I do think this really dovetails with Lauren's research and commentary, is we did try to look a little deeper at more qualitative, robust disclosure. And so Q2, which is whether or not auditor tenure is disclosed, and 71% for S&P 500, yes. Of course, that question's a little less relevant now because since we started this in 2014, auditor tenure is required to be disclosed on the face of the auditor's report, which is not in the proxy, but that data is out there. So what we asked with 2.1 is there disclosure related to a discussion about how the audit committee considers the length of tenure? Good, bad, pros, cons, etc. And that's a much lower percentage. And you can see, and you may have seen in previous slides as well, the S&P 500 generally is higher than mid cap and small cap, but it's directionally the questions directionally tend to be similar. Next question. Oh, sorry, next slide. So for 8.1, similar to 2, we said, so question 8, the historic question is it explicitly stated that the audit committee is involved in the selection of the audit engagement partner? And when we, the royal we, our wonderful partners at Audit Analytics comb through the S&P 1500, that's a bit, there's a judgment as to whether they decide to give credit to the proxy about how that disclosure is made. So 8.1 is their disclosure related to a discussion about how the audit committee is involved. So here what we're looking for is there more description? So does it say whether or not the audit committee chair is involved? Do they interview multiple candidates? Is it just one? Is it the full committee? More description about the process. Next slide, please. Another area that we've looked at, not since 2014, but more recently, is some disclosure about, again, going back to risk oversight. So here the question is it disclosed that the board of directors has a cyber expert? And you can see clearly there's quite a big uptick from 2016 to 2022, 7% to 39% for the S&P 500. This does not mean that the board of directors has a cyber expert, but it's disclosed whether or not there is one. And there could be many boards that have cyber experts and they don't disclose it. So the percentages are just disclosure. Next slide. And then this is whether or not it's disclosed if the audit committee is responsible for cyber risk oversight. You can see that ticked up as well. Next slide. This is the last slide. So for ESG disclosure, we asked in 2022 for the first time two questions, just the same as the cyber. So Q11 there is it disclosed that the board of directors has an ESG or sustainability expert? 39% for the S&P 500. And Q12, is it disclosed that the audit committee is responsible for the ESG oversight? And 18% disclosed whether or not they have that oversight. So James, this is the end of my prepared remarks. As you and I have talked about, and I think you'll have a great discussion with the audit committee members today, what we always hear is that audit committees' interests are aligned with investors, and maybe it's selection bias, but the folks that I talk with are willing to enhance audit committee disclosures. But it's a question of how, and it's, I think, a challenge to avoid a disclosure overload. But with that, I'll hand it back to you.
Thank you very much, Vanessa. I'm somewhat humbled to be able to introduce this phenomenal panel. given their distinguished backgrounds in business, leadership, accounting, and standard setting. So I want to focus on what we are going to talk about. I went to Chat On, a subsidiary of ChatGPT, to find out what the public thinks of audit committees. Generally, the public views audit committee members as important and necessary for ensuring financial transparency and accountability within organizations. They're expected to have strong financial expertise, independence, and integrity to effectively oversee the company's financial reporting and internal controls. The public also expects audit committee members to act in the best interest of the company and to hold management accountable for any discrepancies or irregularities in financial reporting. Today, we will hear from Sheila Huda. She serves on the board of Enact Holdings and previously served on the board of several companies, including Mutual of Omaha Insurance. She's the CEO of Alpha Advisory Partners. She's a lifetime member of the Council on Foreign Relations, and she's been named to the Directorship 100 by both Financial Times and NACD. We will also hear from Bob Hertz. He's the current chair of the Morgan Stanley Audit Committee. From 2002 to 2010, he was chair of the Financial Accounting Standards Board. He was one of the original members of the International Accounting Standards Board, and he's a former partner with PricewaterhouseCoopers. Interestingly enough, he has served on the board of directors of the Sustainability Accounting Standards Board Foundation as well. Thank you for appearing on the panel, Bob. Next, we have David Herzog. He is a business leader with deep experience in insurance and financial service. He is a trusted leader, having served as the CFO of AIG from 2008 to 2016. This is significant because he took over the organization after the crisis. So he was able to navigate after the crisis, after the financial crisis of 2008. He serves as the audit committee chair of MetLife. And our final panelist is Anthony Anderson, who served as the vice chair and Midwest area managing partner of Ernst & Young. He currently chairs the audit committee of Exelon, and he also serves on the executive committee of the United States Golf Association. I do not have enough time to do each of these panelists just by nature of the introduction, but I wanted to give you an idea of the background of the panelists. Since we are talking about something that is incredibly important, and it's been framed by both Lauren and Vanessa, I would like to know from the panelists, do you have any concerns that the audit committee's expanded responsibilities are impacting the core responsibilities related to overseeing financial reporting quality and overseeing management's efforts to deter and timely detect fraud? And we can have Sheila start us off.
Thank you, James, and I appreciate being on this panel. To answer this question, we all recognize that the audit committee's core responsibilities are oversight of financial reporting and internal controls. As business has gotten more complicated and evolved, more responsibilities have been put under the audit committee for the various reasons Lauren has described. What I am concerned about is twofold. One is the bandwidth and workload. And while some of that can be managed through better board and committee processes, like materials and timing, et cetera, what I am more concerned about are director skill sets. It is a completely different skill set to be an expert on cybersecurity or AI or data privacy, etc., than it is on financial reporting and controls. So that is something we need to think about, and that is a concern. Of course, there are ways to overcome it by getting experts or continuing education, committee refreshment. There are ways around it. But this in itself is something that is a concern and needs to be very thoughtfully navigated around.
David, do you have any thoughts?
Thank you, James. And by and large, I agree with Sheila. I mean, the world is getting increasingly more complicated. Demands and, let's say, expectations of many stakeholder groups, not just investors, but regulators, communities, our employees or associates, the expectations are increasing. And so, therein lies the challenge. And I think while I'm not concerned might be too strong of a word, I was certainly cognizant of it, aware of it, sensitive to it. And again, there are ways, as Sheila pointed out, there are many ways to manage this. And I think good boards and certainly good audit committees know their limitations, and good audit chairs will manage the committee to be fit for purpose. I serve on two committees, one MetLife and the other another company, and they each have very different mandates or remits. And the typical meeting at MetLife is 2 hours, and it's a pace to get through the material, but it's 2 hours. The other committee I serve on, it is by design, because of the remit, it is a 4-hour meeting. And so we take the time. What would be troubling if we tried to do 4 hours of work in 2 hours. And so again, I think it's fitting the commitment of time, the resources, the composition. I think Sheila is exactly right. It is about having the right mix of skills and perspectives on these committees to, again, make sure they're fit for purpose.
And I'd like to bring Bob in. Bob, along these lines, given that the primary responsibility is appeared to be to the financials, with these other expanding roles, can audit committees, in fact, take on these added responsibilities without diminishing that primary role? What are your thoughts, Bob?
Well, you said, James, I'm chair of Morgan Stanley Audit Committee, also chair of the Fannie Mae Audit Committee, and I'm on the audit committee of a smaller but growing public company called Workiva. And, I think a key point is that, implied by some of the other comments, is that one size doesn't fit all. In financial services, particularly large financial services, we have a separate risk committee, which undertakes most of the risk. But for example, in Morgan Stanley, we also have an operations and technology committee that, focuses on things including cyber and data privacy and probably now AI and that. So, we're left more with the more traditional audit committee related functions there, which I think is appropriate, particularly in a large financial institution, which is very complex, operates in Morgan Stanley's case, across many countries and many jurisdictions and the like. So, and in the smaller companies, where I found is that whether or not the audit committee assumes oversight of some of the key risks often depends on both, who the members are, but also how complicated the company's business model and operations are. In which cases I found that in some cases Risk is really a whole board responsibility, along with things like strategy.
Thank you much. I'd like to bring Tony in now along this same topic, but given the discussion, Tony, do you think that investors understand what audit committees do? And if not, how can we close that knowledge gap?
Thank you, James. And to everyone, it's really a pleasure to be part of this discussion. You know, I listened to my colleagues, and first of all, I agree with many of the things that were said. And I think it's really important to understand that, you know, companies are different, and how you address it and address a lot of these things are unique to each company. And on the first question that you had, I think that you know, it's almost like the question should be slightly different, and the question should be more along the lines of, how is the board, how is the committee, how are they addressing all of these additional risks, and how are they prepared to address those risks, given that everyone's different, and then a reader can then decide and decide whether or not they think it's being adequately addressed. On your subsequent question, you know, it's hard for me to gauge whether investors are really, really interested in this, because I serve on 4 public company boards today, 3 audit committees, and chair one. This question has never come, I've never seen a question around this from shareholders or from investors. And so, you know, it does make you wonder how interested they are in it, unless there's a problem that's emerged. But I've never heard the question, and I'm sure it's happened somewhere. I've just never seen it. And my companies cover the gambit from, you know, very large companies to smaller companies. And so, you know, James, I find it interesting that they haven't asked. Now, I've also find it interesting that while that's the case, I think there has been a movement afoot to improve the level of disclosure that's made in proxies around what audit committees do. And while that has improved, there's clearly room to go in improving the quality of that disclosure going forward. So I haven't heard feedback from shareholders or from investors around understanding what auditors do or what audit committees do.
So Tony, you just described that we need to talk a little more.
Well, I think so. I mean, I think that's right. And I tell you what. I mean, I talk to investors, but never in the context of audit committees. It's always in the context of other things. It's in the context of compensation. It's in the context of other types of board-related matters. And as I talk to other friends of mine who serves on boards, because I asked them the question coming up to this, coming up to today, and I can tell you it's constant in terms of whether or not they're getting questions around it. And so, James, I would say yes. I think there's an opportunity for us to engage more around what do you want to see, and what would be helpful in making an evaluation about how these committees are operating. The other thing I tell you is that there's a real connection between, a committee like the audit committee and the governance committee. The governance committee is the group that's looking at the composition of the board, looking at, how they're going to be recruiting and bringing on new board members. How's that discussion between the Nom and Gov committee and the audit committee is evolving. And so, when you think about something like cybersecurity, that has, kind of a relationship to controls at the company. So I can understand why it would be part of the audit committee responsibilities. But that also brings up the question around, okay, has it been a priority, and has the company gone out and added to that committee the skill set necessary to evaluate the issues around cyber? And so I think when you start looking at composition of board members and committees, that level of discussion with Nom and Gov becomes really important. And so I'll add that to the conversation.
Thank you very much, Tony. And I'm going to go back to Bob. In Lauren's presentation, she mentioned that her co-author team spoke with investors and they want to know the story of the audit committee. For example, what are the risks that the audit committee focused on in this past year? And what did the audit committee do to oversee those risks? What do you see as the barriers to more transparent and detailed company-specific audit committee disclosures about risk oversight?
Well, first, I think it's important to go back to some comments that were made in terms of the overall proxy disclosure. For example, in the Morgan Stanley proxy, there is a whole section on board oversight of risk. And it lays out which committee and the board are responsible for oversight of which risks in a fair amount of detail. And then you have the audit committee report, which, looking at maybe because the corporate secretaries group always looks at the CAQ barometer report, as well as the EY report, as well as, the audit committee reports and proxies of our, peer banks and those that audit committee members, other boards they serve on. We've got a fairly, I think, expansive discussion of what the audit committee does, and it answers. I think it addresses those questions in the CAQ barometer, and it's been over time using that has been expanding. Interestingly enough, your question about whether investors care or no, maybe one of the highlights of my audit committee service was about 6 or 7 years ago at the Morgan Stanley annual meeting. Representative from one of the major trade unions' pensions actually got up and commended me and the rest of the audit committee for expanding the disclosure in the audit committee report. Yeah, it was kind of.
I appreciate that some investors are, in fact, looking at it. I'd like to go back to Vanessa and Lauren. Based on your research, is there a correlation between audit committee disclosure and audit quality? I'd like to hear first from Vanessa.
Well, we do cite in our barometer one academic study that did say, yes, there is a correlation. And we cited, and it is related to the selection of the audit partner. We also hear and have heard over the years anecdotally that one audit committee member told us a story about how she was insulted by the barometer initially, honestly. And her theory was, why do I need to put in these disclosures? I'm an audit committee member, highly respected. I mean, these are the requirements of the audit committee. Why would I need to tell you what I do? That's my job. But she was, it was requested of her from a shareholder. The shareholder told her that they felt more comfort if it was put in writing, if it was explained, and maybe they don't know all the audit committee requirements. And she did feel convinced that if it was more helpful for her to put it in, she was willing to. But back to whether there's a connection, I think there is some academic research that suggests that, if it's disclosed, you might think harder about how well you're doing something before you put it into a public filing. So that's our research. Lauren, I don't know your experience.
Vanessa, I'm familiar with this study that you're citing. It's a published study, well-respected authors. The only thing I would add to that is one of our interview questions was to have the audit committee member kind of role play with us, and we'd say, okay, imagine that you're reading this detailed proxy statement and there's all this information in it, and then you read this other proxy statement from a different audit committee member and it's quite boilerplate. Would you draw any conclusions across the two? And overwhelmingly they said, no, I wouldn't draw any conclusions. They have different corporate secretaries or they have different disclosure philosophies, but on average, audit committee members are either going to do their job or not. So they weren't convinced that it's causation, but it's certainly correlation. And Vanessa, for the reasons you mentioned, I think there could be some causation. The psychological awareness of having said that you're doing these things does make you think twice, I think, before you do them, heading into those meetings. I think that'd be the only piece that I'd add.
Thank you much. And with that as a backdrop, I'd like to turn to David. Many companies feel that governance is not a one-size-fits-all issue. So disclosures provide an opportunity for companies to communicate to stakeholders that board members are fulfilling their fiduciary duties. What do you think would be the most important things for an audit committee to disclose to communicate that they are effectively overseeing the risks assigned to their committee?
Yeah, thank you, James. Much like Bob referenced at Morgan Stanley, we at MetLife, we have a risk oversight summary before we launch into the specific roles of the various committees. We have 5 standing committees, and like a large financial institutions, we map the principal risks of the company to the various committees. And I think it is helpful for the readers of our proxy to understand that that is how, at least we at MetLife, organize, manage, if you will, distribute risk oversight to the various committees. And well, I don't think we talk about it, but it is certainly it's more than implied. So, for example, ESG, we have a very close. I have a very close relationship with the head of our governance committee, which we lay out in the proxy, that they have primary oversight over MetLife's sustainability efforts. However, as it relates to the data quality, third-party assurance, limited as it may be, those things find their way into audit committee oversight. So we have a very nice way of putting responsibility where skill sets are better matched to do that. And we basically even called out specifically cyber risk and sustainability as a deeper dive into how we as a board and as an audit committee, again, I would agree, many boards probably believe cyber, as do we, as a full board responsibility. And we take the lead in the audit committee, but it is a full board responsibility, and we lay that out in the proxy. So to your point about trying to tell a story, I think it's very important to try to convey, because like my other colleagues, I guess it's okay. I've never heard from an investor as it relates to what we in the audit committee are doing, but you wouldn't want that day to come, if you will, in terms of something going wrong that we weren't at least giving adequate oversight to. I mean, that would be a pretty tough day for people. So I think that's, the proxy is frankly the one and only place we have to be able to convey to investors, this is how we as a board oversee risk, and this is then how the audit committee, and we do sort of tell our story around the specific risks, what the audit committee is doing, how we oversee the auditors, how we compensate them, how we review them, what our role is in selection of the lead partner. Those types of things I think are important to give investors a reasonable line of sight as best you can, because part of this is to take the time to have a succinct enough report that people would actually read it, because more is not necessarily better in many cases.
Thank you very much, David. I'd like to turn to Sheila now. And Sheila, we've heard from both Bob and David in talking about what happens at a large company. You've been a board member of large companies, small companies, developed, growing, the entire range of companies. And so I'd like to get your view from the smaller growth company perspective to see if one size doesn't fit all, are there issues we should be concerned about throughout the entire spectrum? What are your thoughts?
Like my colleagues, I too have never had any investor remark or ask about how the audit committee goes about its responsibilities. It's always regarding compensation or succession and climate and stuff like that. Larger companies in general have more resources at their disposal. And like MetLife, like Morgan Stanley, they can disclose much more. They have the capability. Smaller companies don't have that full breadth of backup resources. They sometimes tend to rely on third parties. Therefore, you may see more of the boilerplate or the ad hoc best practices that they may employ. However, across the entire spectrum, in addition to the points raised of how the audit committee conducts its oversight over the financial reporting and the risks, I see what would happen as once you start engaging more and disclosing more. One additional area that we may think about as audit committee members also disclosing is around the talent in the finance and internal audit function. How does the talent in place to disclose for enhanced disclosures, to deal with the emerging technology usages that run through that should or will be running through the finance function, including the new AI, which may transform the finance and mid and back office functions. So the talent may come to the fore and become something that we think about. Another is the tone at the top and the culture of transparency that the board and the audit committee would like to foster, including things like the focus on yellow flags, certain behaviors, etc. And the third additional point, which I believe Bob mentioned, is how the audit committee really brings together and ties in with the strategy, the purpose of the company, and the overall value creation drivers of the company. So in addition to the other 3 points, I would like us to consider talent, the tone at the top and culture, and then the linkage with strategy and purpose and value driving.
Thank you very much, Sheila. And that provides a perfect lead into what will be our final question, which I would like to hear from each one of the panelists. I began the discussion with something pretty provocative, and that is the fact that we see fraud in the system, and we turn to the audit committees to basically do something about it. And we're not turning to auditors. They have a specific function, and the audit committee oversees the auditors, but they also oversee the internal controls and the management to basically get at the root cause of what some see as an issue. So I'd like to have each one of the panelists, and I'll begin with Tony. What actions, if any, do you think the SEC should take with regard to additional or enhanced audit committee disclosures? And if not, how do we address the issues that we appear to have with regard to the pressures on modern audit committees?
Well, I don't really sit back and say that the SEC needs to put in more regulations around this. I'm not a person who immediately turns to regulations to solve something like this. And given that many of us haven't been engaged to talk about it with investors, I wouldn't want to come up with a solution in search of something. So it seems to me a better way to go at this is to have an ongoing process of providing insight about what would be helpful to investors, and having investors ask or say what would be helpful to them, and helping them evaluate all of these different types of risks. I think you heard from some of my colleagues, it sounds like they do a pretty good job laying out risk and allocating them to committees. I think hearing from the external environment about what they would want and expect, I think is the way to get at that. And maybe even having some rating system around whether, investors think that disclosures around risk that companies are providing are adequate. And so, so I guess my first reaction, I wouldn't necessarily go to the SEC and ask for regulation on this point. I think we go to investors and have investors become more vocal about what they would like to see in the way of disclosure. And that would be my reaction, James. And I'm sure others will have a point of view on that, but I don't see us having the need to have regulations developed for this at this point.
Thank you very much, Tony. What do you think, Bob?
I think it was well stated by Tony. I mean, I think probably more insight from investors before anything is done is always worthwhile. That's certainly when we tried to approach accounting standard setting. And one thing I learned is that investors are certainly not monolithic in their views. There's all sorts of different types of investors, and found often very divergent views. Sometimes you find there is a consensus of a particular view. I'm thinking about it, and I think it goes back more to the question of, how are the risks of the company, overseeing the governance over that. And, I mentioned the Morgan Stanley disclosure, and David mentioned the MetLife disclosure. I guess there is regulation SK Rule 407H requires some disclosure, but, I guess the question is that, are companies doing that in a transparent kind of useful manner or not?
Thank you very much, Bob. And since you mentioned 47H, I'd like to bring Lauren into the discussion. What are your thoughts, Lauren?
Yep. So, Bob, my head is where yours is. We've already got 407H. I'm not sure we need more regulation, but perhaps we need interpretive guidance from SEC staff. I think this is also an opportunity for CorpFin. I pulled some data on SEC comment letters back, that's what's publicly available since 2005. And the last time I saw a peak in comment letters that use the phrases board and risk oversight are between 2009 and 2010. So it's been quite a long time since SEC staff and CorpFin have focused on this specific part of proxy statements, and maybe that's an opportunity. I'll also say our interviews with the 30 audit committee members pretty unanimously stated that they didn't see it as a need for regulation because they thought that the portions most value added were those tell the story portions of the disclosure. So regulation's not going to help with that part.
Thank you very much. What are your thoughts, Sheila?
We can't hear her. I'm not sure if what the connection issues are.
Okay, we'll.
Sheila, hit it one more time. There you go. There, now you're up. Nope, one more time.
Can you hear me? Okay.
Yes.
Okay. Apologies. My colleagues have so eloquently answered this question. I really don't have anything more to add. I would second that we don't need more regulation, and probably maybe following this discussion, and I would expect more written articles and thought leadership around it. Audit committees could probably take it onto themselves to have further, to engage in a way that they would get the investor perspectives and understand what they're requiring from their respective companies.
Thank you, Sheila. And we'll have David.
Thank you, James. Well said by my fellow panelists. Again, I don't know that the answer is more regulation. I think, again, to the extent the SEC can provide interpretive guidance, we all look at SEC comment letters, whether they're directed directly to our companies or not almost doesn't matter, because we look at them and look for emerging themes and direction of travel that the SEC would like us to go. We certainly pay attention to speeches and public commentary. So again, to the extent you want to help shape the dialogue, the discussion, the framework for how we think about these disclosures, because all of us, no matter how robust some are versus boilerplate others are, all of us are looking for continuous improvement and the things that investors care most about. And then, because our job is to oversee and provide people with information on which to make investment decisions. And the more relevant data they have, the better. So again, just anything that the SEC can do to help clarify, crystallize what that is from the various inputs that they get, it would be welcome guidance.
Thank you, David. And Vanessa?
Thanks, James. I certainly agree with all the other panelists. Like I said before, we have encouraged voluntary disclosure. I really like the way, Lauren, that you, which is a different way than we've thought about it in our barometer, those different categories, boilerplate, benchmarking, and leading. I think we do hear a lot of folks are looking for what investors want to say. I don't know if we'll have an opportunity, James, to hear from this group as to what investors want. But but telling that story, it takes time and effort. But I do think if there is a call for it, then as you've heard from these panelists, I think they will respond. But that tell the story, that would be, I agree with Lauren, it would be hard to regulate.
Thank you much, Vanessa. And as full disclosure, I must say that all the panelists differ from what my position was in 2015 when I responded to a concept release on this very topic, audit committee disclosures. And at that time, there was a practical comparison with what the UK was doing with regard to audit committee disclosures. And I compared the basic audit committee disclosure in the US, not one of the leaders, but a basic one, which basically says, our charter's on our website, we've complied with AS 16 and Sarbanes-Oxley, and that's it. However, on the UK side, I compared to the Rolls-Royce audit committee report, which was the company that provided the report, that, in my opinion, would give an investor more confidence because it was a direct communication from the chair of the audit committee. So I do recognize that the panelists who are, in fact, experts in the field and are responsible for the quality of the audits, do believe that we can get by without those additional disclosures, and the best route is on a voluntary basis. I think we do have time for one question. Is there anybody on the IAC who'd like to ask a question? Yes, Colleen.
So first, James, this was a really fantastic panel, so thank you. I felt I learned a lot, and panelists, you were all terrific, so thank you guys so much for your time. I had a quick question, and this is probably for Lauren or Vanessa, but I'm curious, when you went through the reports, was there anything about the auditor, the external auditor itself, besides like the engagement partner and the firm? And for, I guess, perhaps the audit committee chairs, is this something that you guys are tracking or looking at, like, say, turnover of the external auditor, the continual staffing from year to year, those kinds of questions?
I can start, Lauren, if you want. I'll be honest, I'm not the one who combed through 1,500 proxies, so, but I'll say what I think I know from the research that we do talk to audit analytics about from my own reading. I don't typically see explanation at the engagement level detail, such as turnover. When we talked about, we look for whether or not there's an explanation of the fee change. It's usually relatively brief. There's an acquisition and there's a spike. There's an implementation of an accounting standard and there's a spike. So it's typically not about staff. When we see what we call good disclosure about a consideration of audit tenure, often, and this is getting a little boilerplate, honestly, but often there will be a paragraph or two about the consideration of long tenure, and it's usually about the benefits, the way that the audit firm and the team understand the industry, understand the company, the benefits of that continuity. And so and then there's a little bit of discussion about the risks of the concerns that the audit committee might have about independence, impairment of independence with that longer tenure, and what they do to mitigate it. There's obviously a required rotation for the engagement partner and many other safeguards. And so, there's a balance that's weighed. But I can't swear, Lauren, I don't know if in your work you saw engagement team type of disclosure.
No, I haven't. And I'm an audit professor and regularly talk to audit leaders at their conferences. And I've not ever heard a call for that disclosure from them at an engagement level specifically. I will say it was excluded from our study because we were seeking to understand the evolving responsibilities. And so we didn't want to lose an hour of time talking about the external auditor. We knew we could spend a whole hour on that alone. So Colleen, I don't have data from my study for you.
Hey, Colleen, were you asking the question around, is there disclosure around staffing, or were you asking the question around how audit committees evaluate staffing of the external auditor?
I'm interested in both. So I would love to hear, if James, if we're not over time, I'd love to hear your thoughts.
and
Yeah.
to weigh, how you guys consider that.
We are over time, but it's Christopher.
I think we have 4 minutes, James.
Okay, we do have time. Go ahead.
Then I'll start, Colleen, and then I'll ask my colleagues to weigh in as well. We spend a fair amount of time evaluating the staffing that's going to be serving that account, and we look at staffing from what I'll call the lead partner, who's going to lead that engagement, all the way down to who the senior is going to be. And if there is significant turnover, understanding why it happened and how the firm is going to manage it. Oftentimes when there's, significant turnover and it happens, regularly, then, that might even make you start to consider whether or not you have the right firm serving that account. And so there's a significant amount of discussion around that staffing. And I would say it even goes beyond that. So typically I serve on a number of really big companies. And so you get the attention of the senior leadership of the firm serving it. And so how they engage and what value they bring to the table is also evaluated. And as we think about who the auditors should be. That's what I would add to the conversation, but I'll ask my colleagues to weigh in as well.
Can I ask just a very quick follow-up question?
Yeah.
So when you say you look for like high levels of turnover, how do you assess that? Because if there's not sort of a generally accepted, here's the level of turnover in this particular year, or is there, and I'm just unaware of it?
Yeah, so the auditor will provide the detail about who's going to be working on that account every year. And so they'll come in with their audit plan, who are the people going to be. They'll frequently show how many years that person has served on the account, where changes are being made, whether they're just being moved to another part of the audit, whether they're staying in that particular where they were before. But that information is provided and it's typically provided when, in the planning process, so at the beginning of the audit. And so you get to see very clearly who those folks are going to be and their backgrounds. And so you can evaluate whether or not they're the right person to serve that account.
Thank you. That was great. Just one, I guess perhaps I wasn't fully clear. Like, how do you say that, say, 10% is too high? Is it just based on, okay, here are my experiences with this information in the past?
I think it depends on, I think it's a judgment call, to be honest, because it depends on what level, what part of the operations they're doing the work on. I mean, there's a lot of factors that would go into that, decide whether or not it's, if 10% is too high or 5% is too high or 20%. I think it's a judgment call based on all the facts.
Got it. Thanks.
And Tony, what we do at MetLife, we have our internal audit department conduct an annual assessment of the external auditor and how they are serving the various locations around the world. And we get very granular feedback. And Colleen, to your question about turnover, overall, it might be just fine, but in certain key locations, if there's excessive turnover or unplanned and frankly unmanaged succession, that gets called to our attention, because we so much of this is about local service and maintaining a strong working relationship, but independent relationship out in the field. So it's both. It's big averages, but it's localized.
I think that's a really good call out, because we do the same thing. I mean, we do a very significant and in-depth evaluation around how the firm has served the account in all of the key locations around the world. And so we get that data as we're evaluating whether or not that firm should continue or we should start thinking about something different.
Thank you all very much. It's been an absolute pleasure to moderate this expert panel. And hopefully the IAC has been enlightened on audit committees. What is clear is that there's room for additional discussions between investors and audit committees. I thank you all very much. Over to you, Christopher.
James, I'd add my thanks. That was a terrific discussion. I really appreciate the panel giving their time to the IAC, and I thank you for your very capable leadership and moderation of the discussion. That concludes our three panels, and we're next going to turn our attention to proposed recommendations for IAC discussion and voting. The first one on our agenda relates to single stock ETFs, and Andrew Park is going to take us through that. Andrew, you ready to go?
Yes, Christopher. So the Market Structure Subcommittee put together this recommendation based on a panel that we held back in December of 2022. And so the background of this panel was really focused initially on Rule 6C11 from 2019. And so what that rule stated was that ETFs that satisfy certain conditions could come to market without either the additional cost or the time to get approval from the SEC. And so, right, this is a form of exemptive relief that really both sped up and reduced the costs. And so we did hear from panelists, both who had recently issued ETFs and also, in one case, was a first-time issuer of ETFs who talked about the benefits of such a rule. But the other side of that is that we now have these other types of products that have been able to rely on the same 6C11. And so these are single stock ETFs. And by extension, we also took a look at leveraged and inverse ETFs. And so as one other panelist had mentioned, ETFs, when we think about them as diversified, transparent, and generally low fees. But if we look at some of these other products like single stock ETFs, we find that they're quite the opposite of that, right? They're concentrated, they're quite opaque because many of them rely on a portfolio of swaps, and a number of them also do tend to have high fees. And so in thinking through potential recommendations on this, we first went through and looked through, well, who are the holders of single stock ETFs? And it turns out that, maybe it is not of a surprise to many that there's heavily a retail investor base on them. So when checking with a trustee, it turns out that across many of the most popular single stock ETFs, 92% by account belonged to retail investors versus 8% for institutional. So that seemed to make it pretty clear that these are heavily retail owned and traded. But the other problem that we found is that there seems to be a lot of confusion as to how these single stock ETFs operate. And mainly that because, right, unlike some of your more standard ETFs, these single stock ETFs, though they sound very similar, they have a lot of leverage embedded in them. And then they also have this feature where there is a daily rebalancing. And so there's sometimes confusion as to investors thinking that they're getting leverage of a long-term performance, which is clearly not the case, right? This is of daily performance. And that because in many cases we see the name exchange traded being used again, and again, we're talking about very different products. We also thought through, by extension of that, how should we be thinking about some of these other exchange traded products, right? Like exchange traded notes or things of that nature, which again are structurally very different than when we think about our standard ETFs. The final thing that we have noticed is that many of these investors are accessing these products through self-directed accounts. And so this posed a challenge because we have certainly, the SEC has thought of good ways to address what happens when investment advisors and broker dealers are violating their fiduciary duty. But in this case, there's nothing that really dictates what do we do about self-directed investors that are misled or don't necessarily understand the products that they are given access to. So ultimately, this brought us to four main recommendations. So the first is that after much going back and forth, we decided that there are many good features of Rule 6C11. There's no doubt about that. However, I think we thought that there should be some consideration as to whether 6C11 should be revisited, especially because you have these single stock and leveraged ETFs that are able to use that same rule, even though, again, they are functionally very different. Another recommendation that we have is that there should be a consideration for how we name single stock, leveraged, and other exchange traded products. Because again, they should probably be done in a way that conveys some of their unique features and really, avoid the association with ETFs, which are very different. The subcommittee also recommended that the SEC continue to bring enforcement cases against investment advisors, those who are selling and soliciting clients and where it's clearly unsuitable. And so this applies both to not only single stock ETFs, but also some of these other exchange traded products as well. And finally, given the issues around self-directed investors, this is clearly going to be an issue that the IAC is going to have to discuss about how do we address better informing self-directed investors. But one of the ideas that we had in this recommendation is, what if there was a way to have a point of sale disclosure at the time of trade? And in doing so, having a visual disclosure that simply shows, the performance of the underlying asset, the performance of the of this ETF, whether it's single stock, leveraged, or what have you, and just make very clearly showing the divergence in performance to make it clear that whatever investors may think they are receiving may not be the case. And so this is the fact that there's a visual point of sale disclosure is also important, we thought, because a lot of self-directed trading is also being done through mobile phones. And so the subcommittee certainly had a sense that those investors may not choose to read disclosures, but if you have a very simple visual, that would have the effect. And so ultimately, those are the four recommendations that we are going to be making to the commission today.
Andrew, thank you. I'd like to ask whether anyone has any comments or questions. I have one myself, although I'm happy to defer and let others go first. Ted, looks like you've got a comment or question.
Yes, and that was, what Andrew presented was excellent. I just had a question about how do we address Commissioner Pierce's statements that were issued this morning by Thompson. You see if she had some ideas about the recommendation. Do we stop and deal with the things she raised? Do we vote? How do we address her concerns?
Oh, that's a great question, Ted. I did. Everyone got a copy of those from Tanya, and I also made sure that each of the folks presenting recommendations had their attention drawn to them. We're not obligated to address those concerns, Ted. It doesn't affect our voting. I think that she's asking some terrific questions, and each of our recommendation presenters have taken those on board, and to the extent they feel that those questions should be addressed, that would be terrific. I had a good look through them. I actually sent Commissioner Peirce a clarification on one of them, but no procedural impact associated with that. But thank you for asking.
Okay, I just want a clarification. It's fine.
Yep.
Thank you.
Christine, question for Andrew?
Comment. So I'll start by just saying I'm supportive of the recommendation, and I think it's a good start to address some of the concerns. I just want to highlight the connection in terms of our earlier discussion with digital engagement practices, and I think our broader concerns about complex products being purchased by investors in self-directed accounts, perhaps not with all the safety features and education that would be most beneficial to investors. And as Andrew suggested, coming back to this topic in the context of more broadly complex products and self-directed account, I think would be really helpful for us as a committee, and beneficial to investors.
Andrew, my comment is sort of related, so I'm going to go ahead and toss it in now. And that is, you talked about this point of purchase disclosure, which is kind of appealing. I mean, on some level, it's kind of a frightening new reality, right? That these transactions are sort of moving to the mobile phone, and it's so not in keeping with traditional notions of disclosure, and you sort of hate to think about creating a whole new realm of disclosure. And so that's something that we'd all have to really make our peace with, just as a general concept. I think there's a lot of us who certainly could see the benefits of that kind of disclosure, and whether there are unintended costs and so forth is a whole other discussion. But one thing I did note is you said, hypothetically, hey, let's imagine if a disclosure popped up at the point of purchase, and let's say it talked about the performance and how it differs from the underlying stock. That makes me uncomfortable. I would be, much more supportive of a disclosure that said, hey, the design of this product is such that it's not intended to track the stock. Speaking about the design process rather than the merits, and I know that performance doesn't really address the merits of the investment per se, but it's like a little bit uncomfortably in that direction. And so I would just make that distinction that I can get my head around this idea of a type of disclosure that says, do you understand that the design of this kind of product it's built to have a magnifying effect, and it's built to settle every day, and get out of the business of making performance conclusions in the recommendation. That's just an observation. Looks like Paul's got a comment.
Yeah. Thanks, Christopher. Yeah, stepping away from the point of sale disclosure, these single stock ETFs are relatively new, and it seems to me one can make a credible case that it's material information for an investor to understand how the reference security has performed against the ETF over time. And so it'll be interesting to see whether or not the firms that sponsor these products consider that material information, and whether or not they make those disclosures. That's my comment.
Okay. Other comments or questions? Hearing none, the next place we're going to go is a vote on this. But before we do, I'd like to ask Mark to just review who has had to leave the meeting or is unable to attend the meeting, just so we have, since we still have a good solid quorum, but I think it's just helpful for the record to reflect who is and isn't here. Mark, are you on the line?
Thank you, Christopher. So for purposes of the voting record, I would note that 5 members are not present, and please correct me if I'm wrong, but as far as I can tell, the 5 members not present are Jamila Abston, Brian Helmer, whom I understand is voting by proxy, Gina Gale Fletcher, Lori Lucas, and Dr. David Roney. So for purposes of the voting record, those members are not present.
Thank you very much, Mark. That having been noted, I'd like a motion, if I could, to approve the recommendation as submitted and discussed.
So moved.
Can I get a second?
Second.
Second.
All those in favor of the IAC adopting the single stock ETF recommendation, please say aye.
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 Any opposed? Any abstentions? Okay, Mark, that one pretty definitively passed. And so we're going to turn our attention next. Thank you, Andrew, for that. As we've discussed, shepherding that through the process took a lot of work, and you really did a terrific job with that. So we really appreciate your leadership on that. Next up is the recommendation relating to Rule 13D and G and 10B1. And Brian Shore, on behalf of the Market Structure Subcommittee, is going to take us through that discussion. Brian, are you ready to go?
I'm ready to go, Christopher.
Thank you.
Okay. This recommendation of the IAC's Market Structure Subcommittee follows up on two panel discussions that were held in September, on September 21, 2022, regarding Schedules 13D and 13G regarding beneficial ownership reporting, as well as on proposed Rule 10 Cap B1, which covers position reporting of large security-based swap positions. The panel as well covered Rule 9J1, which is designed to prevent fraud, manipulation, and deception in securities-based swaps positions. At those panels, the panelists discussed a wide range of topics, including the historical basis for 13D and G, their views on information asymmetry caused by the current rules, and potential insider trading concerns. Despite the proposed rules being proposed separately, they touch on a common thread of information dissemination. We note that earlier this month, on June 7th, the SEC adopted Rule 9J1 with modifications to the rule as originally proposed, and the subcommittee supports that rule. The proposed rule amendments governing beneficial ownership are designed to update beneficial ownership reporting under Exchange Act sections 13D and G to provide more timely information. In assessing whether or not the current 10-day deadline still serves the primary purposes of Section 13D, which are to provide information to the public and to the issuer about accumulations of stock by persons who have the potential to change or influence control, and to regulate rapid accumulations of beneficial ownership that occur within a short period of time, the SEC determined that an amendment to Rule 13D1A is needed to adequately support those regulatory objectives. It is noted that the current deadlines for filing the initial Schedule 13D and 13G have not been updated since 1968 and 1977, respectively. The proposed rules regarding securities-based swaps relate to proposed Rule 10 Cap B1 and would require any person or group of persons who owns a securities-based swap position that exceeds certain dollar-based threshold amounts set by the rule to publicly file with the SEC within 1 business day after exceeding certain dollar-denominated relevant thresholds, a statement disclosing the following information: the identity of the reporting person and the security-based swap position, as well as the underlying loans or securities and any related loans and securities. And unlike large equity positions, which must be reported to the SEC quarterly or when positions exceed 5% of the outstanding shares, No such requirements exist for swaps positions. Accordingly, this rule was proposed by the SEC to enhance market transparency, improve market integrity, and strengthen the security-based swaps market overall. In part, they respond to the issues identified following the March 2021 collapse of Archegos Capital Management, which shed light in turn on the use of total return swaps. This follows separate issues that were identified during the 2008 financial crisis relating to credit default swaps, which in turn led to the SEC being granted certain authority by Congress under the Dodd-Frank Act of 2010 with regard to rulemaking with respect to securities-based swaps. The proposed recommendations are summarized as follows. With regard to Schedules 13D and 13G, the subcommittee's recommendation on timing of initial filings is broken down into two parts. First, where the SEC proposed shortening the filing period for active and passive investors from 5 calendar days after crossing the 5% filing threshold to 5 calendar days, the recommendation is that the Schedule 13D and G filing periods for active and passive investors be shortened to 5 business as opposed to 5 calendar days after a shareholder crosses the 5% reporting threshold. A business day standard would be consistent with other SEC filing requirements, which are framed in terms of trading or business days, such as 8Ks, which generally require filing within 4 business days, Section 16 filings, 2 business days. Second, with respect to qualified institutional investors, QIIs, and certain exempt investors, the SEC proposed that those investors would have 5 business days after the month end in which they cross the 5% threshold, as opposed to the current 45 calendar days after the end of each calendar year. The recommendation of the subcommittee with respect to those 2 groups of investors, QIIs and exempt investors, is that the initial filing period should be 45 calendar days after the end of the quarter in which the filing threshold is crossed. Turning to the treatment of cash-settled derivatives under 13D3, the subcommittee is not making a recommendation with regard to the SEC's proposal regarding beneficial ownership with respect to those cash-settled derivatives, which would treat holders of those derivatives as beneficial owners for 13D reporting purposes, even though the holder does not have any voting power. Instead, the subcommittee's recommendation that 13D3 and Rule 10 Cap B1 should be, quote, better aligned, close quote, is referring to timing, namely that whatever security-based swaps rule may or may not be enacted should not substitute for or front-run 13D beneficial ownership disclosure requirements and vice versa. Which leads me to 10 Cap B1 and security-based swaps. With regard to security-based swaps markets and proposed Rule 10 Cap B1, while the subcommittee's recommendation acknowledges SEC efforts to seek to improve the SPS markets, the subcommittee is not making a recommendation with regard to specific reporting thresholds, other than to recommend that while the proposed rule proposes dollar-based reporting thresholds with security-based swaps over equity securities, the recommendation is that SBS reporting or equity-based swaps be tied to a percentage of the issuer's outstanding shares or the economic equivalent for SBS related to the issuer. While there was no consensus on a specific percentage, as a general matter, a percentage should be aligned with the issues proposed rules are trying to solve. Similarly, the subcommittee is not making a recommendation on the timing of security-based swaps disclosure. As noted earlier, Rule 10 Cap B1 should not be a substitute for or front-run the Schedule of 13D's beneficial ownership disclosure requirements. Finally, with regard to the definition of group, 13D-5, the subcommittee is not making a recommendation with respect to the definition of group under Rule 13D-5 because of a lack of consensus on the effects of that proposed definition on shareholder communication. The subcommittee does, however, agree with the SEC's description of existing case law on the definition of group and believes that including that description in any final 13D rulemaking would highlight to market participants the scope of existing case law when considering the applicability of the group rules. Separately and apart from the recommendation itself, a question has arisen as to whether shortening the 13-day reporting date to 5 business days would discourage economic activists. Intuitively, it seems to me that in the small cap space where there is less trading volume and it takes longer to build a stake, decreasing the filing period could have an impact on economic activists. Christopher, that concludes the formal remarks.
Very well done, Brian. That was a good summary of a pretty complex set of issues. Do folks have any comments or questions for Brian? Brian, one thing that I would note is that last time these things were updated in the late 60s, early 70s, filings and everything dealing with the SEC were done in paper.
Mm-hmm.
And complying with slightly shorter timelines is certainly less burdensome in today's digital world than those same deadlines would have been at the time the original rules were written. The other comment I guess I would make is, can you extend your thinking a little bit more fully around economic impact on activists? Tell me, you said yes, you think there's an impact there. Can you expand your thinking on that?
So I think in particular, what I was referring to was the smaller cap, where there's less trading, where the trading volume is not as great. So if you're dealing with a smaller cap company where it takes time to build a position, your ability to go from 4.9 to above 4.9 is going to be hamstrung if the number of days is decreased from 10 to 5 or 5 business days. Whereas, I think that would also be the case with a large cap or a mid cap company, but given the volume of trading, you might be able to buy a significant number of shares during that 5-day period after you cross 4.9%. In the smaller cap space, where it could take weeks to build a position, having 5 days, you're limiting by 50%, or however the math works out in terms of actual number of days. The volume, because of the decreased volume that you'd see in the small cap space, the ability just to buy a significant position. I think I would have to defer to the economists and those that have done research on the ability to buy and how much is bought between the point where you cross 4.9 or cross 5% and 10 days versus 5 days. And there has been some research on that point. But that's really, that's what it comes down to is
yeah. We'd also need some
definition.
research. Yeah, we would also need some research about whether this kind of trading is the majority of it is in higher volume, more liquid stuff, or whether there is a lot of trading in the more thinly, a lot of position accumulation in the more thinly traded stocks.
Exactly.
I don't know if you know that, but I don't.
No. I think there's been some research, but I don't know if it's been stratified to that degree where they've actually looked at small cap versus mid cap versus large cap to see the differential.
Mm-hmm. Mm-hmm. Andrew, thoughts?
Yeah. So, and thank you for that, Brian. I think when I know that we have been discussing this issue for some time now. Which is why I think we had this panel well over a year ago. And one of the issues that I know that has continued to come up is, you mentioned this whole issue of this economic impact, and I think we're talking about this from the buyer's point of view, right? I mean, for every single day that someone crosses 5% and doesn't report that, that is one less day for for a seller to who then also knows this information too. And so, I guess one thing I'll point out is that, right, for for the longer that there is this period between, right, this lag time between when someone crosses that threshold versus when it's reported, right, this also does have an impact on the sellers as well, because from there are various statistics on this, but the ones that I've seen is that on average, after a 13D filing is announced, that position will usually rise by 7% or so. So that is a gain to that delay is a gain for the buyer, but it is also a loss for the seller. So I think that's why there's been a lot of, certainly a lot of discussion on these issues, but I did want to kind of just also highlight that fact too.
Andrew, I think that's a fair point. We did have a fair amount of discussion on these points, obviously. Whether or not there is whether or not the seller has adequate liquidity, you're also impacting the ability of a seller to be able to sell. If you make it harder for a buyer to buy, that means that on each side of the transaction, there may be less of an ability, there may be less volume and less of an ability for that seller to sell, regardless. If a seller wants to sell, regardless of that information symmetry, as you might characterize it, you might not be giving that seller the opportunity to sell if the buyer is now stopped from buying because he or she or the institution has bought 5% or more, has to file 13D after crossing 5%. So look, it is a debatable point, and we sort of came out in the middle here with 5 business days, 5 trading days.
Other comments or questions? All right. Seeing none, the next move here is to vote. Before we do that, I'd just like to reflect the fact that Jamila has been able to rejoin the meeting. Welcome back, Jamila. Can I get a motion to approve the 13D and G recommendation?
So moved.
Can I get a second?
Second.
All those in favor of adopting this recommendation, say aye.
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 Those opposed?
Aye.
Any abstentions?
One.
Mark, I think I recorded everyone in favor, no oppositions, and 1 abstention. All right.
Correct. Thank you.
Thank you very much, Brian and Andrew and the whole team that worked on it, and everyone who weighed in by survey and participated in multiple discussions about this one. A lot of thought and care and attention went into this, and it's nice to see it made it across the finish line. So congratulations to the team that worked so hard to bring it here. All right. Our final proposed recommendation relates to the oversight of registered investment advisors. And Paul Roy is going to lead that discussion. Are you ready to go, Paul?
I'm ready to go, Christopher. Thank you.
Thank
This
you.
is a recommendation flowing from the Disclosure Subcommittee of the IAC. We had a panel discussion on March 2nd, 2023. That included representatives from the SEC's Examination Division, from NASA, Securities Administrators Association, the state regulators, the Investment Advisors Association, and the Consumer Federation of America. It was noted that advisor oversight is bifurcated between the SEC and state regulatory authorities. As of 2021, there are over 32,000 investment advisors in the U.S., with 375,000 investment advisor representatives. And these investment advisory firms manage almost $129 trillion and serve over 65 million clients. There was particular focus by the committee on the growth in the number of investment advisors. Since 2016, the number of registered investment advisors has increased 25% to over 15,000. And over that same period, the number of private funds managed by SEC registered advisors has increased 40% to over 50,000. Now, this is a growth rate that far outpaces the SEC staff increases. Over the same period, the SEC exam staff has increased only 4%. In 2021 alone, 900 new advisors registered with the SEC. And unlike broker-dealers, there's no self-regulatory organization to assist the SEC in overseeing the investment advisory industry. Thus, the SEC and the state regulators are the only entities conducting exams of investment advisors. In 2022, the SEC's Examination Division conducted examinations of 15% of registered investment advisors. Now, this equates to a 7-year exam cycle, assuming the SEC examines every investment advisor, which it may not. Now, Congress has twice responded to this capacity challenge facing the SEC's Investor Advisor Examination Program by reallocating federal and state responsibilities for the regulation of registered investment advisors. First in 1996 with the enactment of NISMIA, and then next in 2010 with the enactment of the Dodd-Frank Act. As predicted by the SEC staff's Dodd-Frank study in 2011, examination staffing has not kept pace with the growth in the industry. The current exam cycle of approximately 7 years, in the view of many members of the IAC, is inadequate to detect or credibly defer fraud in the investment advisor industry. In the Dodd-Frank study, the SEC staff recommended that Congress authorize the SEC to assess user fees on investment advisors it examines, and that revenue derived from such fees be used to fund additional advisor examinations. So clearly, with registered advisors having 65 million investment advisory clients, effective oversight of the investment advisor industry is an important investor protection issue. The IAC, the subcommittee, is recommending that the best way to ensure effective oversight of the investment advisor industry is to ensure that the SEC has adequate resources to maintain an effective examination program. However, congressional budget appropriations to the SEC each year are uncertain and never seem to keep pace with industry growth. To effectively detect and deter fraud, we believe SEC registered investment advisors should be examined no less frequently than every 4 to 5 years, with higher risk firms being examined more frequently. Given that the growth in the number of SEC registered advisors is likely to continue, the IAC believes that user fees imposed on investment advisors would allow the SEC to have a stable source of funding and allow for an effective exam cycle and keep up with growth in the industry. So therefore, we're reiterating the recommendation that the IAC made back in 2013. However, given that user fee legislation has not been enacted, although it has been passed by the House of Representatives several times, The IAC considered various alternatives to the user fee approach. We looked at whether or not there should be another reallocation of responsibilities between the SEC and the states, whether there should be a self-regulatory organization for the investment advisor industry, whether FINRA should be given the authority to examine registrants that are both registered as broker-dealers and as registered investment advisors. And then we looked at whether or not, we looked at the concept of third-party examinations of advisors. And after considering those alternatives and the fact that the user fee legislation for 10 years has gone nowhere, the IAC is suggesting that the SEC do a request for comment on whether or not a third-party examination regime to supplement the SEC's investment advisor examination program makes sense. A third-party compliance examination firm could focus on routine examination issues and make factual findings on the accuracy of, for example, the Form ADV and website disclosures, verify assets, the maintenance of required books and records, and compliance policies and procedures. A third-party exam requirement could have the following benefits. It could increase frequency of exams beyond what is presently possible under traditional SEC funding levels. Free up SEC resources to focus on and perform more in-depth reviews of firms that pose greater risks to advisory clients and to conduct for-cause examinations and address emerging risks. Allow the SEC to use these third-party compliance reports to improve risk assessments and profiles of advisory firms, and permit initial reviews of newer advisory firms, which could be required to have an initial third-party exam within a reasonable period after commencing operations. We recognize that a third-party compliance examination regime presents a number of key issues that would have to be addressed, and we've outlined those in the draft recommendation. Now, given the current bifurcation of oversight between the SEC and the states, we think it's important that there be greater consistency in oversight of the advisor industry. Therefore, we're recommending that the SEC join NASA in encouraging all states to adopt the model investor advisory representative continuing education rule and the model policies and procedures rule. Now, the policies and procedures rule is similar to Rule 20647 under the Investment Advisors Act, which requires SEC registered advisors to have comprehensive compliance policies and procedures and to designate a chief compliance officer. The policies and procedures model rule lays out specific written policies that investment advisors must adopt, implement, and enforce. The investor advisor representative continuing education rule requires 12 hours of continuing education credit for representatives who are registered in a state. Now, this requirement applies to all registered investment advisors, representatives, whether they work for a state registered advisor or SEC registered firm. The 12 credits are divided into two 6-credit components, one on ethics and professional responsibility, and then one on products and practice requirements. And with this rule, NASA members seek to ensure that investment advisor representatives maintain their knowledge of ethics, regulatory requirements, products, and practices within the securities industry. We believe these rules have considerable investor protection benefits. Before I go to questions, I'd like to address some comments that Commissioner Peirce made with regard to this recommendation. She asked the question as to whether or not this user fee rule would undermine Congress's role in appropriating funds to the SEC. And what I would say in response to that, if you look at the legislation that was passed by the House of Representatives a number of years ago, that legislation contemplated that the user fee approach would be incorporated and reflected in the appropriations process for the SEC's budget. So I think if that legislation is used as a model, I think that would eliminate any questions about congressional oversight of the use of these fees. Again, that could be a model. And this is not unprecedented. The banking regulators, user fees are largely used by the banking regulators to cover the cost of bank regulation. So Congress is familiar with this kind of approach, and I would expect that there would be effective oversight if this user fee legislation were to advance. She also asked questions about the third-party exam requirement and option. And again, we recognized a number of these questions that she outlined in her comment, and we recognized that there's substantial questions that should be addressed before the SEC would move forward with a proposal like this, which is why our recommendation is a request for comment to consider key issues with regard to how this program would work to supplement the SEC's examination program. Issues like who will be qualified to conduct these exams? Would the cost be prohibitive? How would it impact small advisors? All those questions are teed up in our recommendation, and those that we haven't called out in our recommendation that Commissioner Peirce calls for could be incorporated into a request for comment and given commenters an opportunity to address those comments. So again, I think that our motivation for the third-party compliance request for comment was the fact that the user fee legislation has not progressed. And as I indicated, our committee discussed other approaches that could be effective in terms of bolstering the SEC's ability to oversee the industry and conduct effective examinations. And we thought the third-party examination approach had the most merit for exploration. So with that, Christopher, I'd be glad to address any comments or questions.
Hey, Paul, thank you. That was a very comprehensive introduction. I see Chen has got his hand up. Chen, comments, questions?
Yeah, thank you, Christopher. First, I'd like to thank my fellow committee members, Paul, your group. You did an excellent job putting this together. So I want to acknowledge that as a practicing advisor today, this is something that's going to directly affect oversight on myself. So as a result of that and any potential, perception of conflict of interest, I will abstain from this vote. But I did want to make a couple of comments, which are that I broadly support the need for increased examinations, especially with the unprecedented growth in this space. We need to be thinking about this now before it gets out of control, which some would argue it probably already, the numbers have gotten that large already. So a couple of points there. I do have that same concern with user fees with respect to, are we circumventing Congress at all and what we need to do there. So the commission to navigate that would be really, really important. Third-party examinations. I realize we're kind of looking at this as an alternative solution to perhaps the budget issue internally. But boy, if there's a way we can figure out how, from a budgetary perspective, to keep that in-house and have the SEC be doing those examinations, that I believe would be the preferential situation there. So just a comment there. And then the third thing is, again, as an advisor, I think we do not emphasize enough the ongoing continuing education of our advisors in terms of new products, in terms of ethics, in terms of senior protection and things of those nature. So I'd be absolutely supportive of that as well. So thank you. I appreciate all the work you guys have done on this.
Yeah, thank you for that, Chen. And I think in our discussions about this recommendation, I think there was a strong sense that, our preference is that the SEC has sufficient funding to conduct the examinations. But, you know, time and time again, the SEC is strapped for resources, trying to keep up, and its mandate just keeps getting larger and larger. And as you point out, the growth continues to be significant. And you know firsthand that many reps in the broker-dealer space are shifting over to the advisor world. So that's a trend that is ongoing and likely to feed the growth. But again, I think on the third-party exams, we thought it was worth at least asking the question and getting the discussion going about whether or not there's an alternative. But thank you for your comments.
All right, Paul, you got a good number of questions queued up here. Leslie was first, Jamila is second. Then we're going to go to Christina, Paul, and then finally James.
Thanks so much to Paul and Christine for their great work in putting the panel together and drafting the recommendation. I know what a difficult task that is, and they did such a great job. I think it's indisputable that the SEC is in dire need of more money to do more exams so that they can have a higher percentage of IAs examined every year. And I fully support this recommendation in regard to the user fees and in regard to the support of enhanced advisor compliance program. However, with great respect, I strongly object to the idea of delegating an essential governmental regulatory function to a non-governmental third party. For this reason, I probably won't be able to support the proposal as it exists. First of all, the significant cost in setting up and supervising such a program seems to me it would be far better spent on hiring and training additional exam staff and investing in technology within the SEC. The inherent conflicts of interest and the risks of a check-the-box mentality are likely to result in less trustworthy exams if delegated to third parties. I strongly object to the use of third-party examiners in any area that would require the exercise of discretion or judgment or the interpretation of policy or law. I've been a securities regulator for over 20 years now. I've personally witnessed how, even when designed by regulators with the best of intentions, in reality, the implementation of these programs, which outsource regulatory functions, often ultimately generate results vastly different than the anticipated outcomes. One example of this is when FINRA allowed arbitrators to recommend expungement of investor complaint records maintained in the CRD in arbitration cases that had not gone to a full hearing on the merits. In these settled or straight-in cases, what was intended to be granted not as a right, but only as an extraordinary remedy, has turned the CRD into a dry erase board where expungements are granted by arbitrators in the most ordinary of circumstances, resulting in widespread deletion of state public records based on a system that has not worked as intended. Arbitrators hired to resolve a dispute are often litigators who don't think like regulators. They can't exercise that function with the same mindset as a regulator and work with different priorities. Expungement in general remains problematic and has required numerous rule revisions by FINRA over 20 years to try and align the nature of this extraordinary remedy with the types of cases where it should be recommended. I expect their work and that of NASA on that subject as well is still not done. I really fear that a similar type of situation might arise if we delegate exam responsibilities to third parties. And so for this reason, I can't support this recommendation, although I truly hope the SEC will adopt the portions of this recommendation that I do support. Thanks.
Leslie, thank you for that. What do you really think?
Well, can I respond
well
to Leslie? I mean, again, I would reiterate that, you know, as we discussed this, our preference is that the SEC gets sufficient funding. And it's not enough to say it would be better for the SEC to have the money to hire more examiners. It's just not happening, which is why that led us to the third-party exam request for comment. We didn't move directly to a proposal because we recognize there are a number of issues that need to be sorted through. Now, in terms of, you know, your experience with, you know, the arbitration situation, I think, you know, the SEC has sufficient funding. And again, I would reiterate that, you know, our preference is that the SEC gets sufficient funding. And it's not enough to say it would be better for the SEC to have the money to hire more examiners. It's just not happening, which is why that led us to the third-party exam request for comment. We didn't move directly to a proposal because we recognize there are a number of issues that need to be sorted through. Now, in terms of, you know, your experience with, you know, the arbitration situation, I think what we tried to emphasize in the recommendation is that, what you have third-party examiners do is very important. And we specifically said in the examination that we didn't want them in the subjective judgment business, that the scope of this could be such that they're there to examine objectively determined factual information that could be reported back to the SEC. So it wasn't to, introduce people making subjective judgments and interpretations of SEC rules. So, I think we were cognizant of that. But again, I respect your views on this. And, as Commissioner Peirce pointed out in her comment, folks can legitimately say, well, this should be a government function and not outsourced to third parties. But, again, we're to the point of we keep beating our head against the wall in terms of the SEC having enough resources. And at some point, there could be a major scandal in the advisor industry that gets missed because the examination cycle now is every 7 years and may grow. So, we're, as Chin pointed out, we're trying to get ahead of an issue. And this may not be the answer, but it's at least, in our view, worth the discussion to be had and the issues to be fleshed out. And if it goes nowhere, it goes nowhere. But we thought it was worth a discussion and to get public input.
Well said, Paul. Jamila.
Hey, Paul. Thank you so much for this work on this recommendation. As a former examiner, right, 8.5 years, and I understand exactly the need for more support, like truly need for more help with the exam team to get through even more sizable percentage of registrants every year. So totally support you in that vein. But given that the third parties that were mentioned include accounting, auditing, consulting firms like myself working for Ernst & Young, I am going to abstain to be clear to not present a conflict of interest. So thank you for your work, and look forward to seeing where this goes.
Understood. Thank you.
Thank you for those comments, Jamila. Appreciate it. Christina.
Thank you, Christopher, and thank you, Paul. I just wanted to say a couple things. Number one, one of the reasons I was very interested in this recommendation is because I am very concerned that the lack of a reasonable exam schedule for registered investment advisors is really going to affect the successful implementation of Reg BI. And Reg BI, I think, is incredibly important to retail investors. So I am hearing and have in the dialogue we have all had by email on this recommendation concerns about whether or not third-party examiners are the right way to go. But I really want to commend Paul and everyone who's worked on this recommendation. I think what you're inviting is that dialogue. You're recommending that the SEC request comments on the matter, and you're acknowledging that resources are the core of the problem, which is the last point I wanted to make. Whether it's user fees or an appropriations or someone paying for third-party examinations, this is all going to come down to how will we pay for these exams and who's going to pay for them. So we really need to surface that conversation in a more pointed way. I think this recommendation is a helpful step along that path, and we're gonna have to figure this out. There's more RIAs than ever before, and Paul is right. We really don't know what's going on with them. All due respect to you, Chen. Thank you.
Thank you for those comments. I think that's a distinction that's really worth making. I hear where Leslie's coming from, but I think Paul did a very nice job of the design of this recommendation. You don't have to support third-party examinations to support this recommendation, because really, in some ways, it's not a red herring, but like, let's look at this whole issue. And if you aren't comfortable with third-party recommendations, then maybe you pony up some budget, because in other words, it's a forcing function to to get the resources needed. So I share the views of others who don't love the idea of third parties even collecting data. I do think Reg BI is hugely important, and so for those reasons, I support this recommendation as it's very thoughtfully been designed. Are there other comments or questions? James.
So I'll go ahead and add my 2 cents as well. And thank you very much, Paul. And interestingly enough, given my background, I'm not sure if you went even far enough in describing how bad it happens to be. Going back more than 20 years, there weren't enough examinations. In fact, it was more painful for an investment advisor to be registered at a state level because you're more likely to be examined than at the federal level even more than 20 years ago. So there's been a need to correct. I think it's more pronounced now, and we need to decide whether we want to protect investors, especially older investors who've accumulated a lot of money, or whether we want to protect investment advisors. And I think we should protect investors. And I think you are hitting on one potential solution. I know it's not the perfect option, but I think it gets closer to protecting investors. So I support.
Thank you very much, James. Paul, you had your hand up, got in the queue, and then you got shy there for a moment, but now it's back up. What can we do for you?
Yeah, I just wanted to note and reiterate the appreciation that I and we have for everybody that worked hard to put this recommendation together. As an investment advisor representative as well, myself, there's an inherent conflict, and for that reason, I will be abstaining from the vote.
Thank you, Paul. All right. Other comments yet? Brian?
Christopher, like Paul, I will be abstaining as well for the same reasons.
Okay, thank you. Ted, your thoughts?
Well, I support the recommendation. I've had, in one of my previous positions, I had the responsibility to oversee a third-party audit program, and we had to sort of shut it down because it was being manipulated by one or two auditors. You know, they just rotate around. You know, in terms of the same two firms that always do the auditing. So so we had some issues with it, but I don't think that that experience I had is any reason for me not to support the recommendation. So I would agree that we move forward.
Thank you for those remarks, Ted. Did I see a hand up for a minute there? Was that you, Brian?
Nope, I had mentioned my comment that I'm abstaining.
Good. Okay. Mm-hmm. Any other comments or questions for Paul?
All right. Christopher, I would just want to thank Christine, Brian Helmer, Sandra Peters, others, Colleen, others who weighed in, Leslie, helped shape our thinking, and appreciate all the input that we got from the IAC members on this. So I just want to thank everybody.
Good teamwork. Well done, everyone. All right, let's put this to vote. If I can get a motion to adopt the recommendation relating to the oversight of registered investment advisors.
So moved.
So moved. Second.
Can I get a second? Thank you. Appreciate it. All those in favor of adopting this recommendation, say aye.
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 Any opposed?
Nay.
One opposition, and any abstentions? I think we have at least 3 noted.
Abstain.
Yep.
Abstain.
One, two, 3, 4. 1, 2, 3. I see 4 abstentions, Mark. Given that this is kind of close and we have a couple of people absent, Mark, unless you disagree, I think it would make sense to go to a recorded vote on this.
Certainly, Christopher.
And you have Brian Helmer's proxy, don't you, Christopher?
Yes, we do. So why don't we just get Brian Helmer's proxy taken care of first, Mark? This was one that Brian did support.
Noted.
And if you could just take us through the roll call, that'd be terrific. Thank you.
Very well. Jamila Abston.
Abstain.
Cambria Allen Retzlaff.
Support.
James Andrus.
Support.
Chen Asuera.
Abstain.
Tess Daniels.
Support.
Gina Gale Fletcher is absent. Elissa Germain.
Support.
Brian Helmer is noted, votes yes by proxy. Colleen Honigsberg.
Support.
Christine Lazaro.
Support.
Nancy Lamont.
Support.
Lori Lucas is absent. Christina Martin Ferbita.
Support.
Christopher Mirabile.
Support.
Andrew Park.
Support.
Sandy Peters.
Support.
Dr. David Roney is absent. Paul Roy.
Support.
Brian Shore.
Abstain.
Paul Summerstadt.
Abstain.
Alice Steinbach.
Support.
Leslie Van Buska.
No.
Joanne Yu. I believe Joanne Yu has dropped off and is not present for this vote. So, Christopher, it looks like the yeses have it with 4 abstentions and 1 no vote.
That's my reading as well, Mark. Thank you for taking us through that, just to be safe for the record. So that recommendation passes and will be published along with the other 2. That's a pretty heavy load today. Like I said, a 6-pack, 3 and 3 recommendations and panels. Terrific discussions in each case. Thank you all for the work that you put in to this. The final agenda item for us today is just to receive working group and subcommittee updates. So if I could go, I'll start, Paul, since you already have the microphone. I'll start with you for an update on the working group on access and inclusion.
Yes, thank you, Christopher. Again, just reminding folks of the goal of the working group to ensure that the IAC factors in access and inclusion issues into the work of the IAC, particularly with regard to our focus topics. We've met 3 times since the March meeting. Each meeting, we've discussed potential access and inclusion topics for the IAC. And indeed, the Digital Engagement Practices panel today was co-sponsored by the working group. At the March meeting, we met with the leadership staff of the Office of Minority and Women Inclusion. We discussed the activities of the office in their newly released annual report. At the June meeting, the group noted the June 14th program of the Small Business Capital Formation Advisory Committee, where they addressed funding gaps for underrepresented founders and startup companies. And we also discussed the fact that the SEC has a new public service campaign focused on elderly investors. The working group also discussed ways to encourage more firms to complete the SEC's diversity assessment report for the upcoming fiscal year 2024. I would note that the Office of Minority and Women Inclusion has put out for public comment some revisions to that report to hopefully encourage more registrants to complete that diversity assessment report and provide it to the commission. We also discussed outreach to groups promoting access and inclusion in the securities industry and securities markets. So that's my report, Mr. Chairman.
I was going to say, Paul, it is and it isn't, right? Because you're also on deck to cover for Brian on the disclosure subcommittee. So your work is not quite done yet.
I thought Christine was doing that.
Is she doing that?
Christine,
Yeah.
Yeah.
Excellent, Christine. Thank you. My notes were out of date. So, Paul, thank you again for that update and for the work you put into this meeting. Christine, over to you for disclosure.
Great. So brief update. Since the last meeting, the disclosure subcommittee worked on the panel presented this afternoon on ensuring digital engagement practices responsibly expand investment opportunities, as Paul said, in conjunction with the Access and Inclusion Working Group. We also worked on the recommendation that Paul presented regarding registered investment advisor oversight. And really a big thank you to Paul, who took the lead on both of these items. This coming quarter, we are planning to continue to discuss potential topics for upcoming panels, and we'll consider whether to make any recommendations following today's panel on digital engagement practices.
Christine, thank you for that update. I appreciate you pinch hitting on that. Cambria, can I get an update from you on investor as owner?
Sure. Thank you, Christopher. And to keep this short and sweet, so we've met, I think, 3 times since the last meeting. And typically our meetings have covered the topics that were on today's agenda, including the 3 recommendations. We had quite a bit of discussion about all 3, as well as 2 of the previous panels that the owner subcommittee has hosted. One on the accounting and auditing panel from June last year, as well as the human capital panel from September of last year, and whether to move forward with recommendations on both of those topics, as well as other issues of interest to the committee. So that there concludes my report out from the Investor as Owner subcommittee.
Thank you very much, Cambria, and thank you for your work on behalf of the committee and the IAC. Andrew Park, would you like to give an update on market structure?
Sure thing. And this will be fairly short and simple. The market structure subcommittee met 3 times since our last meeting. So we met on March 16th, April 20th, and May 18th. And those meetings were going over the recommendations that we voted on today, including on single stock ETFs. And so discussing that, discussing many of the issues on 13D, G, and 10B1 as we saw in the recommendation today, and also discussing the panel that we had this morning. So those are the meetings, and we saw the output of those meetings today. So back to you, Christopher.
Well done, Andrew. Thank you. All right, Chen, bring us home with an update on purchaser.
Excellent. I appreciate it, Christopher. Yeah, purchaser met just before this meeting on the 12th, I believe it was. We were talking all things this meeting, quite frankly. So looking forward, if you will, a couple of things that we're looking at on our committee. We're certainly going to, at our next meeting, talk about today's panels, particularly the digital engagement practices. I'm sure we'll have a robust discussion on what we heard today there. Our committee is working on an open end, looking at a recommendation on the open end liquidity rule. So that is coming, probably be addressed here shortly and be ready for September. Let's see here. Our committee is really interested in revisiting the accredited investor definition and kind of looking at what that means. We've kind of kicked that can down the road quite a bit now. So our committee is really looking to dig into that. The commission has asked for, and we're going to really commit to trying to find out how we can get them feedback on their education outreach and things of that nature. That's something that we've heard quite a bit that they would like some feedback on. So I think that's something we will work on as well. And we are trying to arrange a meeting for hopefully, definitely the purchaser subcommittee, but probably the whole IAC. We've got somebody internally from our senior client protection team, Mike Duff, who will talk about, he sits on FINRA's senior protection committee, and he's got a lot of information for us on trusted contact adoption and things of that nature that I think might be very, very informative to our committee. So we're working on getting that set up as well. Christopher, I'll turn it back over. Thank you.
Well done, Chen. Thanks very much. And I think on accredited, I think that's one that Cambria's got a lot of passion around over at owner. Cambria, you anything you want to add there?
Yeah, no, my apologies. I should have mentioned that. Yes, so that is definitely a topic that we're looking at closely in the owner subcommittee as well for a potential September discussion.
And Chen, Cambria's got some already done some legwork on that topic, and so there could be a good opportunity for the two subcommittees to coordinate, which would be fantastic.
Perfect.
Well, believe it or not, I know we thought this would never end, but we're actually at the end of our agenda. I think we're all cross-eyed in terms of how long we've been sitting in front of our cameras, but everyone was a good sport and it was a great discussion. I'd like to take a moment just to thank Mark and Adam and Christina and the whole staff with a particular shout out to Mark and Tanya, who stepped in for Adam today. So a lot of work went into producing this meeting, and we're super grateful for the help we get from the folks at the SEC in support of our work. Unless there are any other comments, I would entertain a motion to adjourn.
So moved.
Moved.
Second.
All those in favor?
Aye.
Aye.
Mark, we adjourned at 5:12 p.m.
Okay, thank you.
Great
Thanks,
meeting. Thank you
everyone.
so much, everybody.